I think the equity market's sort of really nicely sort of set up from here.
There's lots of opportunity within this market.
But there's the overall tech market. I mean, to get out the popcorn moment.
Even at rich valuations, it is going to be earnings growth that is going to drive the market.
We're starting with the Magnificent Seven, but over time we see the gains and the positivity spreading.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Okay, let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, your equity market on the S&P 500, coming off the back of the biggest one-day gain of the year so far. Equity futures totally unchanged this morning. Stack lineup. Bramo is out. Peter Cheer of Academy with us for the next 60 minutes on this program. Peter Cheer, we've got to talk about one single name, NVIDIA, and let's go through these numbers. $276.65 billion in market cap in a single day. And allow me to go through the list of companies that have a market cap smaller than that big one-day gain just yesterday on NVIDIA. I'm talking about Salesforce, Netflix, Bank of America, Coca-Cola, Pepsi, McDonald's, Disney, Intel, Verizon. The list goes on and on. Peter Cheer, yesterday, we added a Pepsi to the market cap of NVIDIA.
Yeah, it's been almost insane. We saw, what was it, on February 2nd, Meta did almost the same thing, right? That was $200 billion, which seemed like a huge number at the time. This is even bigger. What did Wall Street get so wrong that it was off by that much? And I think Wall Street didn't actually get that much wrong. It got a little bit overdone. And even if you go back until like later in the morning, it was back to levels that it traded at last Tuesday. So as exciting as it is, it also dropped $150 billion in a week. So
this is the disconnect that I think we've been talking about around the table. Annmarie was talking about it yesterday. I was as well. We're only talking about a beat on the forecast of $2 billion US. And that beat of $2 billion seemed to unleash a rally, not just in a single name, not one sector, one country, but across the planet. Pete, can you make sense of that?
No, to be honest. And I think I look at it. So you look at the NASDAQ 100. I think it was just below 18,000 on February 9th, 2 weeks ago. So, yeah, it's an all-time high, but it's barely an all-time high. I think everyone's forgetting we sold off pretty hard on Tuesday and Wednesday coming into the earnings. We bounced into the close, then it rallied hard yesterday. I think this was kind of, to me, it's almost the last gasp. Everyone now who was caught short, everyone who was uninvested is pulling in. And I understand what's going on. We really like AI. We believe AI is going to change things. The problem is, did it get too expensive? Is the data ready for AI? And if it's really going to work, the rest of the market has to be successful. It has to translate into overall PE rise for everyone.
I've got your read in front of me. This is what Pete's got to say for the next 60 minutes. I'm reloading to the full bear mode. We can find out what full bear mode means in the next couple of minutes. Let's turn to the price action to get your Friday set up. Equity futures on the S&P 500 looking a little something like this. Equity futures on the S&P pulling back just a touch. We're negative here by 0.03%. In the bond market, yields climbing again, up 2 basis points on a 10-year, 434. And in foreign exchange, totally unchanged on the euro, 108.23. Joining us through the next 60 minutes, coming up on the programme, Marky Patel of Allspring, with US stocks pushing all-time highs. Pierre Ferragut of New Street as NVIDIA smashes records for a single day. And Matthew Bartlett of Derby Field Advisors as Nikki Haley vows to stay in the race against Donald Trump. We'll begin with our top story. NVIDIA smashing records, adding $277 billion to its market cap in one session. The company on the verge of joining an exclusive $2 trillion value club. Marky Patel of Allspring writing this: NVIDIA's results not only relieved uncertainty about NVIDIA and AI growth, but also resolved investor concerns about the health of the technology sector and economic growth overall. Margie Patel, I'm pleased to say, joins us now for more. Margie, let's go with Pete's line. I'm reloading to the full bear mode. Margie, are you?
No, I think this shows that the economy is strong, or at least strong enough to have a pretty good results for the whole year. And I think a lot of people were just waiting on the sidelines. This affirmation, I think, is going to open the floodgates for a lot of that money sitting on the sidelines, that it's okay to come into the market.
Now, do you think that much money is coming into the market, or is this, to me, I'm a little bit concerned everyone was already piled in, and this was a sigh of relief that everyone had already bet on this and was hoping for this?
Well, I think people actually were expecting a disappointment and a big market correction to go through the whole market. That didn't happen, so we saw a quick reversal. And I think that mentally people are still thinking we're locked into some kind of an economic cycle precipitated by the Fed. The market has not been very sensitive to what the Fed has done. The market's looking at the numbers, at revenues, and also at margins, which have still held up. And these sectors in the tech sector are very, very strong. That looks like that's going to continue. So I don't see any reason why we should get a meaningful correction. We may chop around, but I'm not looking for much of a correction.
And will this start translating into a broader market rally like we had in November after NVIDIA earnings then? That was what seemed to precipitate the rally in the Russell 2000 stocks as a whole. Can we expect that sort of thing right now? Or is this still going to be maybe a tech-led rally?
Well, I don't know if I'd say exclusively tech. I think it's going to be a narrow market to those companies that have above average growth. So that would be tech, because they've shown that. I think a number of industrial companies were very, very strong, and I think they're positioned to be on a secular increase. It's a sector that's rather undervalued. And also in the healthcare sector, parts of that look like they've hit bottom and are ready to do a little better. So broaden out, but only to companies that have good earnings growth.
Margaret, you mentioned the Fed, and I find it fascinating as well. The front end of the yield curve has repriced 50 basis points. Since the last day the Fed met. At the end of the close, I think we're at 420 that day, through 470 in the last couple of sessions. Margie, why do you think this equity market is now willing to de-emphasize the importance of what is happening at the front end of the yield curve?
Well, because I think really when you look at a market of interest rates, roughly say 4 to 4.5% for Treasury rates, that really shouldn't be an impediment for economic growth or for good returns on equities. So I think the market is disregarding it. So many companies have restructured their balance sheets, and they really aren't sensitive to these little tweaks that the Fed is doing. I think the Fed would like to be more relevant, but they really aren't when you look at margins. There's really no sector that you can say is so vulnerable to Fed increases that could cascade into a recession. So things look pretty good, and the Fed is on the sidelines trying to be an important player in this.
They're patient, apparently. They're not in a rush, and we'll talk more about that a little bit later. Peter Cheer, Marko Kolanovic of JP Morgan seems confused about this. I don't think he's the only one. If you think about how this rally started at the end of October, this was engineered by this idea the Federal Reserve was about to pivot, that we'd get maybe 7 rate cuts in 2024. We're pushing that out. We're reducing the amount, so the timing and the magnitude has changed, but this equity market, Pete, has carried on rallying. What explains that?
It's kind of rallying because yields have been...
No, Peter Cheer, please.
Sorry, yields have been going higher for the right reasons, right? We're seeing job growth, the economy seems to be holding together. So I think the markets can do well if we're rallying for those reasons, rather than when yields go higher because we're worried about deficits. I think that's going to be a problem that comes and hits the market in the coming weeks and months as we go through the election campaign and yields go higher for the wrong reasons. Right now, yields are going higher because the economy seems to be doing well. Equity markets can rally on the back of that. Again, to me, though, it's been a little bit too narrow. Even you go through yesterday, markets were up 3%. Most stocks were up 1.5%, 2%. I don't like that. I want to see the full-scale rally where Russell 2000 outperforms everything.
Margaret, you wanted to jump in. Please do.
Well, I just don't think we can look for a classical kind of recovery the way we've seen in other cycles. All our cycles previously have been driven by the Fed, so we mentally think we should see this rotation in the markets and in sectors. It isn't happening. Economic growth has been at least moderately strong. It certainly isn't fading that much. It may be slightly below that 3% level, but that's still good enough to produce double-digit equity returns over the whole year. So I'm not worried about interest rates. As I said, 4% should never be an impediment to economic growth or good returns on stocks.
Margaret, you can make the argument that the US economy is strong, but relatively speaking, Europe's been absolutely dreadful. We've talked about the GDP in the UK, negative. In Germany, negative. In Japan, negative. And yet you look at the equity markets over there, we've got all-time highs in Europe in the last 24 hours. Germany on the DAX, France on the CAC 40, and even in Japan, we're talking about record highs there. Numbers we haven't been talking about since 1989. Margaret, how do you explain that one?
Well, I think, number one, the competition from interest rates is so low, people do look at equities. And also, there are signs of, I wouldn't say vibrant growth, but a little bit of signs of growth that even in those countries, Japan, England, Germany, that have had a little bit of negative growth, that it may, in fact, modestly pick up. And just a modest pickup is really all we need to take stocks higher.
And I would just add that most of these companies are very global. So the U.S. companies, 50-60% of the earnings come from U.S. Most are foreign. You look at the foreign indices; they're made up of companies that really benefit from the global growth. So I think it's really hard to say UK companies in the UK index are really
I totally
UK
agree,
anymore.
Pete. The struggle I've got, though, is when we talk about global growth, what are we talking about? Whose growth?
You know, I do think people have been shoving money into equities because it's quote-unquote the only game in town. What I find really interesting is I've been getting long China. It's starting to rally a little bit. And my theme, I think we're going to put out a note this weekend, is everyone says don't fight the Fed, but it's okay to fight the Chinese Communist Party. If the Chinese Communist Party wants those stocks to rally, I think we are going to see a massive short squeeze in China. I don't think it's investable long term, but I think for a trade, that's probably my favorite foreign market right now. 9
days of gains on a CSI 300. I think the longest daily winning streak going back to 2018. A note dropped in my inbox this morning. SocGen, is it time to turn more positive on China? You're not alone. We'll catch up with Jay Pulowski a little bit later on this morning. Margie, can you give me your call on what you think about what is happening in China right now? We know based on our reporting that they're restricting selling, net selling, around the first 30 minutes of the open and the last 30 minutes going into the close. Margie, is that sufficient to say this is a trade now? They don't want people to be short?
Well, I think that when you look at the Chinese economy, clearly there's strong trend continuing to decelerate, and I think that is the long-term picture of China is slower and slower growth, less and less competitive compared to other economies. So they can tweak it here or there, they can put those restrictions on, but it just seems fundamentally there are better places to invest your money for long-term. China's, I think, in a slow motion downward for a number of years.
Margie Patel of Allspring. Margie, great to catch up. Fantastic to hear from you on a record-breaking week in this equity market. Equity futures on the S&P 500 just about unchanged after closing yesterday at an all-time high on both the S&P and the Nasdaq 100. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Shonali Basak. Hey, Shonali.
Good morning, John. That huge rally in NVIDIA shares has catapulted CEO Jensen Huang to new heights. He's on the verge of becoming one of the 20 richest people in the world. Huang's wealth jumped $9.6 billion yesterday to more than $69 billion, and it's a gain that leapfrogged him ahead of Charles Koch to 21st place on the Bloomberg Billionaires Index. And AT&T said a widespread outage that took hours to resolve on Thursday was caused by a, quote, incorrect process while expanding the wireless network. The software issue had interrupted service for hundreds of thousands of subscribers and prompted the FBI and the U.S. Department of Homeland Security to investigate the outage. AT&T said all wireless service was restored on Thursday afternoon. And for the first time since 1972, the U.S. is back on the moon. Intuitive Machines landed a robotic spacecraft nicknamed Odysseus on the moon's surface Thursday afternoon, and it's the first private flight firm to successfully place a vehicle there. Following the landing, NASA's administrators said in a webcast, "Today is a day that shows the power and promise of NASA's commercial partnerships." And that's your Bloomberg Brief, John.
Hey, Shonali, thank you. Very, very cool. Can we just pick up on that AT&T story? I think we were down for about 9 hours yesterday. Annmarie, are we now ruling out a cyber attack?
Well, this is what the Homeland Security and the FCC is going to be looking into. Was this a cyber attack, given this outage for hours that happened in the middle of the night and then extended through people's morning? At this moment, the U.S. administration wants to look at everything. Remember, they have been dealing with cyber attacks across, and have been talking about them, across U.S. industries, whether it's pipelines, whether it's cloud computing, AT&T. This is a concern for the U.S. government.
Wally Adeyemo, the Deputy Treasury Secretary, joining us a little bit later this morning. We're going to be talking about sanctions on Russia, but we'll try and squeeze in some questions about that as well. We'll catch up with Wally at about 8:45 Eastern Time, so about 2 hours and 30 minutes. Equity futures right now on the S&P, as I say, totally unchanged. Up next on this programme, the last two Republican candidates going head-to-head.
She's here. She's down by 30, 35 points, and everybody knows her. You're not supposed to lose your home state.
South Carolina will vote on Saturday, but on Sunday, I'll still be running for president.
That conversation just around the corner, live from New York City this morning. Good morning. What a week. It's been absolutely exhausting for many of you. I think a week was just in a single day yesterday, with the S&P 500 up to all-time highs on the Nasdaq as well. This morning, bit of calm for you. Unchanged on the S&P. Yield higher by a couple of basis points on a 10-year, 434.26. Under surveillance this morning, the last two Republican candidates going head-to-head.
She's down by 30, 35 points. And everybody knows her. You're not supposed to lose your home state. She's doing very poorly. She lost in record numbers in Iowa, record numbers in New Hampshire.
Many of the same politicians who now publicly embrace Trump privately dread him. They know what a disaster he's been. South Carolina will vote on Saturday. But on Sunday, I'll still be running for president. I'm not going anywhere.
She says she's not going anywhere. Well, here's the latest. Voters in South Carolina will head to the polls for this weekend's GOP primary. Nikki Haley trailing Donald Trump by around 30 points in her home state, according to the latest polling. Haley is vowing to stay in the race no matter the results. That is a change. Matthew Bartlett of Derby Field Advisors joins us now for more. Now, Matt, let's get straight into this question, a question that Nikki Haley herself is struggling to answer. What state can she win, if anyone at all?
That is the right question, and there is no right answer to that. Listen, it's been a wild ride on Wall Street this week, but it's still kind of a rocky road on the campaign trail. Tomorrow, I think that clip just encapsulated this entire race. Flashback a week ago, you, Lisa, Annmarie just did an amazing interview with Nikki Haley on critical issues, domestic, foreign policy. And then you saw Donald Trump, who continues to be something of a political pundit from the sidelines. Oh, and also the frontrunner for the Republican nomination. So it's just a very weird cycle. Nikki Haley in her home state looks like it's going to be yet again another loss, another defeat. But I think from her speech, from even yesterday, it looks like she is pivoting from a presidential campaign to much more of a messaging campaign, where she is going to continue to point out Donald Trump's either personality flaws or unorthodox policies.
So home sweet home isn't so sweet when it comes to South Carolina, but you didn't answer John's question. Is there a state she can win?
I think the old Canadian band said it, the night they drove old Dixie down, a Yankee's going to lay her in her grave tomorrow. No, there is not a place where she is going to win. Now, some people are saying, she could be running for second place in case first place goes to jail. A very rare, slim chance on that. I think she even ruled out 2028, saying that she knows her political future with the Republican Party is dead right now. So she's going to go out on her own terms. She's going out swinging. She's probably not going to win tomorrow or anywhere else. But she's going to go out on her own two legs. She's got a group of donors that appreciate her message, appreciate what she's doing, and she's going to continue on. Listen, in politics, it's always a fine line between a fool and a hero, between bravery and stupidity. And I think what she's doing now, we won't have a clear indication as to what it is, maybe until what happens in November.
Well, this is what a lot of Republican lawmakers and operatives are saying. Does she just stick around if the former president cannot run? But most people in politics say you don't back out because you don't have the will to do it. It's because of the resources. So is her whole game here is to just build up a war chest for whatever she decides to do politically in the future?
Unclear. Yes, she has donors. Typically, you are so right, Annmarie. You get that right. Campaigns don't end because people don't have anything to say. They end because they don't have money. She still has money, and she still has some things to say about Donald Trump and Joe Biden, to be quite clear. But she is becoming, the Republican for Democrats. She is becoming the Republican for independent and moderate voters. That is absolutely damning when it comes to the GOP nomination. The base, the MAGA Republicans, they don't want that. It is about a feeling. She is adopting, whether it's a left wing or talking points or, about Donald Trump. It looks as if she knows this. She's doing it deliberately, and she, is going to go out the way she wants to.
From a market's perspective, I've been advising clients that this election cycle is going to be very, very different because normally we go through the primaries, then you get to the convention, and then the real election campaign starts. I think everything's going to be pulled forward this year because it seems like it's already decided now. Is that a right or wrong message to be giving to clients?
Oh, Peter, you're exactly correct. We have never, ever seen a scenario, a dynamic like this with two old, elderly presidents, that, you know, one being the current and one being the former. So this is a very weird time where you're going to have undoubtedly a lame duck presidency coming up. So in terms of advising clients, in terms of what will happen in possibly probably a divided government, no matter who wins, it's going to be negligible is what most people think. But beyond that, what you just pointed out, Peter, we are going into a rematch that most Americans do not want. And there are going to be a lot of V's here. It's going to be a vindictful, a vicious, possibly even a vile campaign that ultimately will lead to victory for someone, that will be pretty bloodied up even after a win.
You kind of killed my next question, because I was going to ask, is there any way that this doesn't get very divisive and angry within the country? And it sounds like it's going to head that direction.
I mean, I think it already has. You have both parties absolutely dug in. Both parties cannot fathom a person voting for the other side, which is just an incredible dynamic. Forget two parties. It almost feels like you have two different species here in this town and across the country. It is polarizing. It is divisive. And again, let's remember, most Americans don't want either. And that's why I think Nikki's continuing to kind of pound away down there.
Which is just absolutely nuts. Matt, before you run, can you give us a number? What kind of spread are you looking at? How big is that gap going to be when we get the results from South Carolina? We're talking 25, 30 points, maybe more?
30 points, and I'm still taking the over.
Wow. Matthew Bartlett of Derby Field Advisors, thank you, sir. Describing Nikki Haley as the Republican candidate for Democrats, which is certainly not how you're going to win a primary for the Republican Party. Pete, we've had a conversation in the last couple of days. It's a conversation that I think Lisa is really focused on, really focused on. The policy and the policy gap between these two individuals we're all focused on. How business-friendly is this Republican Party going to be if they take back the White House?
You know, I think it's going to try and be business-friendly. What I'm increasingly concerned about is as people digest the campaigning, we're going to realize the deficit is going to balloon, and it doesn't matter which party. The Republicans are going to say we're going to cut taxes and do various things, and that's going to keep the budget in line. That's not going to work, I think, in people's minds. The Democrat side is coming at a spending angle and saying the spending is going to help the economy so we don't have to worry about the deficit. I think the deficit is going to become a huge issue again, just like it was in September, October, as people realize neither party cares about the deficit.
Because they all want to spend, and they all add to the deficit.
One way or the other, it's either by spending or by reducing tax. It's going to grow, and I think that's what people are going to realize, and that's when we get another wave higher in bond yields, and that's the wave higher that's going to be difficult for equity markets to digest.
OK, pause. You think we can retest the highs of last year?
I think so.
Again, at the long end.
I keep thinking that this reminds me a lot of what happened in 2006, 7, and 8 in the mortgage market, where you had things crack and come back. I think last summer and early fall was the first time the Treasury market had cracked. It was for sale every single day. It didn't matter what economic news came out. Treasury yields went higher, bond prices lower. That was the first crack. We resolved it. I think we're going to see cracks like that appear again.
I know the 20-year auction is a bit odd, and I feel like I'm taking on Lisa's role because she's not here, but does it hint at the Treasury's issue with issuing longer-term debt?
I think there's a lot of chatter now. Do they have to do something with quantitative tightening? Do they need to do some sort of Operation Twist to, reshape the yield curve? Yeah, I think people are going to start saying, wow, it's never going to get better. We're going to issue more and more debt. And maybe you go through periods of time where, OK, this quarter was great. We had tax revenues. It is getting higher. Yields are slowly creeping up. And people forget how long it takes for the average coupon to go higher for someone who issues so much debt with such long. That's all happening.
What happened to that wall of yield-hungry buyers that were going to step in when a 10-year gets to 450? What happened to them? They go quiet?
They do go quiet. And I always kind of think about, everyone says they want to back up the truck. When Treasury's at 4, if they get to 4.25, I'm going to buy. Yeah. Well, that's assuming they get to 4.25 for no good reason. You get to 4.25 for a good reason, and we're starting to slip. I think we're going to get to 4.40, 4.60 as the next range, with a real risk of going to 5 rather than back to 4.
Interesting. Pete, stick with us. Pete's going to be with us through the next 30 minutes. In the next hour, we'll catch up with Earl Davis of BMO, also looking for high yields at the long end. And just another programming note for you. Record highs in the equity market, not just stateside, but in Europe too, both on the DAX in Germany and the CAC 40 in Paris, France. And also, big winning streak over in China, 9 days of gains. Jay Poloski of TPW has been waiting for that victory lap moment on China. Well, he's had 8 or 9 days. He's going to catch up with us at about 8 a.m. Eastern Time. Coming up next on this program, more on NVIDIA's record-breaking day. Live from New York City, you're watching Bloomberg TV. This is a snooze compared to yesterday. Equity futures on the S&P 500 going absolutely nowhere, following the biggest one-day gain on the S&P going back to January of last year. Equity futures on the Nasdaq down by about 0.12%. The Nasdaq 100 just inching a little bit lower, heading towards, and we're well on course on the S&P for a solid week of gains. If you get to the bond market, switch up the board and take a look at the 2-year. Wow, have we repriced. Inching higher, yields up for a fourth consecutive week, up another 2 basis points, 4.7327 on a 2-year. If you go back to the end of January, the Federal Reserve meeting, the close on that Wednesday, we were looking at 4.20. The 2 years repriced by more than 50 basis points, and yet still this equity market has carried on rallying, which has just been absolutely phenomenal to see. Want to finish on foreign exchange just briefly and take a look at the euro side of things. The IFO index out of Germany, not that bad, not great either, but certainly it's a low bar in Europe, as you've seen with the data all week. 108.29 on the euro at the moment, just a touch stronger on that currency pair. The euro firmer by 0.06%. Under surveillance this morning, the magnificent one stellar week continues. NVIDIA shares surging to an all-time high yesterday, the biggest single session gain in market value ever. Shares jumping 16%, adding about $277 billion in market cap and bringing the chipmaker's total market value near $2 trillion. NVIDIA's surge surpassing the $197 billion single-day gain made by Meta only 3 weeks ago. Peter Cheer, stellar run. And great to see you, because you've got a refreshing call. Never mind jumping on the bandwagon full bear. For the people just tuning in, can you give us a snapshot as to why you are turning in the other direction?
So I haven't liked the price action probably since early February when we saw that crazy move in Meta. Again, anytime something moves $200 billion, as you said, at McDonald's in one day, you watch it, things were weak. I shudder to think what would have happened if NVIDIA missed. We were down 3% basically coming into that. It rebounded. And it felt awful out there. You were starting to see a lot of zero-dated expiration options pushing for this on the put side. And yes, we're at all-time highs, but the NASDAQ 100, I think, is 18,000. It was 17,970 a week ago. So let's not get carried away. This saved the day. And I have this feeling that within the next day or two, everyone's going to be like, OK, so what's the next catalyst? What takes us higher? And I think this whole money on the sidelines, the money's been added to the market. It's been put dip buyers. I think we're fully invested. I think we're susceptible to a pullback.
How do you get a read on that? Can I just ask that question? Because this was described going into the print as one of the most crowded, if not the most crowded trades on the planet. And yet seemingly there were people who weren't in this trade.
So part of that was last week it was at 694 or something like that. So they'd already had a bit of a pullback. The other problem, and this is where I think we all have trouble dealing with a company like NVIDIA, where its weighting in the index is much greater than most money managers can get comfortable. A lot of money managers can only be invested, say, 5% in particular equity. So weirdly enough, even a lot of the NVIDIA bulls are probably technically underweight versus their index benchmarks. So I think that causes a weird dynamic where people have to chase it even if they're already long. And again, yesterday would have been more concerning to me, and I may be turned very bullish, if you saw other names up 3-4%. But I looked across the board. A lot of the other big drivers were up 1.5%, 2%.
Sure.
It wasn't a widespread rally. This was people getting squeezed into the markets, and it was lackluster. It kept going up during the course of the day. Look where Meta did after their big gain. Yep. They were lower up until yesterday.
Stock is up again this morning, up by 1.4% on NVIDIA. I promise we'll talk again about AT&T, so let's do that. Saying a widespread outage, which took hours to resolve yesterday, was caused by a, quote, incorrect process. I've no idea what that means. While expanding the wireless network, the software issue interrupted service for hundreds of thousands of customers and prompted an investigation by the FBI and US Department of Homeland Security. AT&T said all wireless service was restored by the afternoon. 9 hours after it first went down. AMH, we were thinking about this. I think people are talking about this. Have we pushed aside the idea this was a cyber attack?
So AT&T is trying really badly to push it aside. And to your point, Jonathan, processing error very much feels like, to me, turn it off, turn it on. There seems to be some sort of engineering failure. But the federal government, according to our reporting, is looking into this, whether or not this was a cyber attack. So the Department of Homeland Security is going to be involved in this. The FBI, the FCC, they are not going to put that aside. And what's so concerning is similar to our discussion yesterday with the head of the LA Ports Authority, China infiltrating infrastructure.
Pete, you've got generals on the team at Academy. What did they say to you yesterday?
Yeah, so we have 3 or 4 who are very cyber-specific. They are being asked by everyone what's going on. What we can say is everyone's clearly questioning, was this a cyber hack, was it not? So far, there's no indication. But it is a really good reminder that we kind of live in this world where I think we view cyber as this digital. Oh, I lost my ID or something. The risk of it going from digital to physical is real. We saw it with the Columbia Pipeline, I think, as you mentioned earlier. This is going to be real, and we have to figure out how do we deter properly. Instead of all we have is kind of name and shame, we have to figure out a policy that at a national level is, what do we do if we're hacked?
It's a great point, because at one point, when you talked about China and cyber, it was, say, a hotel company worried that their data would just be stripped of all these guests that arrive. But then when Colonial Pipeline happened, you actually saw this massive infrastructure stop, and it actually hit real prices and real people every single day. And this is where you have the U.S. administration incredibly concerned.
AT&T right now up by 0.1%. I want to talk about international security, a different dimension. The Biden administration is set to announce new sanctions against Russia. The latest package is expected to target 500 people and entities linked to the country's war effort. President Biden teased the new penalty shortly after the sudden death of Russian opposition leader Alexei Navalny last week. This weekend also marks 2 years since Russia's invasion of Ukraine. We've got tons of questions for the Deputy Treasury Secretary, Wally Adeyemo. We'll catch up with him at 8:45 Eastern Time. AMH, first question for you. What is it?
Well, I think it has to be, can you give us a little bit more details about these sanctions? If it's 500 people and entities now, why didn't you do them over the course of the past 2 years? We saw the aluminum market move. Are metals going to finally be potentially on the table when it comes to sanctions? And then finally, I have to ask, is it high time to get rid of this price cap and actually sanction Russian energy? Because Putin continues to sell. Sanctions just created new markets. India has replaced Europe for them in terms of their export flows, and they're still making money for it. Maybe they're not making as much, but they are still making money, and that is how he is funding this war.
Pete, do we need to rethink all of this?
One, I think sanctions really don't work very well. And you're even seeing, I think where it worked a little bit in Russia was on high tech on the military side. And you're starting to see ways around that. North Korea is getting involved. It doesn't work. And one of our weaknesses, I think, as a nation has been our fear of energy inflation. We're talking about what you just mentioned in Russia. And Iran is selling 3.5 million barrels of oil per day, well above their sanction, and we're turning a blind eye. I think we have to really focus on a domestic energy policy that gets us back to true independence, and not just on the production, but on the refining, and then we can tell everyone, you do what you want, we're good.
But we have a domestic energy policy. We are the biggest producers in the world. More than 13 million barrels a day, record of any country under this administration. They do not want to discuss it.
Wally Adeyemo, the Deputy Treasury Secretary, will discuss it a little bit later this morning, 8:45 Eastern Time. Let's return to our top story in the last 24 hours. NVIDIA, the company nearing a $2 trillion market cap thanks to historic gains during yesterday's session. Pierre Ferro of New Street Research joins us now. He's got a buy on NVIDIA and a new price target of $9.25. Pierre, wonderful to catch up with you, sir. The obvious question I've got to ask is $9.25. I'm looking at the number. We're still climbing. Are you bullish enough?
It's a very good question, John. I am very bullish because, as you do, I see like the generative AI revolution playing out today, and I can't really dismiss the super bull case where we see the deployment of these AI clusters keeping going in 2024, in 2025, in 2026, and in 2027. Okay, because this is a very credible scenario. You have 200 million users of generative AI today. What if we have 1 billion users in 4 years? That's the speed at which the number of internet users grew in the late 90s and the early 2000s. It's completely credible. What if people who on average use generative AI for 3 minutes a day today use generative AI for 15 minutes a day in 4 years from now? If you add up these things, hold on, NVIDIA as a stock can still triple over the next 4 years. Okay, so that's the bull case. And as this bull case is around, it's very difficult not to be constructive on NVIDIA. Now, the visibility we have on that bull case is not very good because we don't know what's next in generative AI. The only thing we know is that every time we grow the size of these models by 10x, it pushes the veil of ignorance, as Sam Altman puts it, and we discover new features and new functionalities. So there is also a risk that at some point, generative AI cools off. And that's what I reflect in my price target, which is over a 1 year horizon, we know the current momentum is going to keep going. and the stock could appreciate by at least 20%.
NVIDIA yesterday, just to jump in, Pierre, it was amazing to see the numbers and then see the reaction to it. And sometimes you can learn more about a stock by how the stock reacts to the information and not just the information itself. If I was to say to you just 2 days ago, when we last spoke, that when they come out with a new outlook, it's going to be $2 billion north of what the street is looking for, would you have guessed we'd have the parabolic move that we'd got off the back of that?
No, definitely not.
So what was that?
Definitely not. Two things, I think. One is that a lot of people start thinking NVIDIA is getting toppish, and so as we get into numbers, they're getting worried about like an okay set of numbers and the stock pulling back significantly. So you probably have edges coming into the numbers, and that creates a bit of a squeeze when the very good numbers are coming through. That's number one. And then number two, last night, 2 nights ago, the NVIDIA management didn't only share very good numbers for next quarter. They made extremely bullish comments on the conference call about the visibility they have for this year and for their next product generation. What they say is, we are supply constrained. Demand is higher than our supply. And what we tend to know relatively well is how the supply chain is ramping up. So we know that if NVIDIA is supply constrained for the next product generation, the very nice rally you see today, earnings big, etc., is going to keep going for another 18 months. And that's where anyone who was cautious on NVIDIA basically gave up.
So my question is, I think we can all see that AI is improving, and in 5 years, AI is going to be way better than it is today. My concern right now is the data good enough to support the current level of spending on AI? Is the data that's needed to drive AI really there, or is that going to be the snag?
You mean the training data or the information?
Yeah, the data that's out there that people can then leverage AI into.
So here is what the plan is. As AI gets better, AI generates data. And so the medium-term outlook for AI models is you have, for instance, one model generating data, generating movies, and another model is being trained on that. So the generation of data is growing actually as fast as the models are growing. So that's one of the key technological bets we are making in the next 3-4 years.
Pierre, does it not concern you, and Bank of America put this out when they talked about the biggest risks they have to the market this year, that this concentration of these tech firms at the top of the market are the most exposed to geopolitical risks?
Yes, of course it's a concern. In particular, one of the names we like a lot in that setup is TSMC, with fabs based in Japan, in Taiwan, just off the coast of mainland China. And yes, every time we try to run a scenario on a serious deterioration of the geopolitical context, it's difficult to find a business that is not going to be very heavily exposed. So that's a very systemic risk for the whole group, yes. In like the hardware tech supply chain, for sure.
Yeah, can I just finish on Tesla and EVs? We've had so much bad news in that sector over the last few weeks or so. But how would you frame it? How are you framing it for clients right now? Is it a problem for everyone else, or Tesla too?
Well, I've been telling you the same thing for quite a while, John, which is that thinking about the car market as EVs versus non-EVs is a mistake. There is a single market, and that's the car market. And some of these cars are EVs and some of these cars are not. That's a fact. But most importantly, some of these cars are good cars and some of these cars are bad cars, okay? And so you have people who do great ICs, great like gasoline cars, and they are doing like terrible EVs, and these cars are not doing great because they are not very good. And then you have some people, a handful of people, and as you can guess, Tesla is part of them, who are doing great EVs. And these players are doing much, much better. It's still like they're not growing like 50% a year with prices going up as they were 2 years ago. So that phase of like explosive initial growth for these models, for Tesla, for BYD, is progressively going behind us, but they are still gaining share and doing very well in that market. So I think what we're realizing today is that not that many people can do great EVs that can really survive in the long run in the market. And so for traditional makers, it's a question of making more progress towards EVs. And I think for Tesla and BYD, the market is going to remain very, very good.
Hey, Pierre, good to hear from you, as always. Busy couple of days for you, I'm sure. Pierre Ferro there of New Street. On NVIDIA, that stock just about positive in the pre-market. And on EVs as well. Peter Cheer, how investable is the auto sector right now, given some of the news we've had over the last few weeks?
You know, I think the auto sector is slowing down. We had that demand pull forward. Everyone's trying to figure out. I am increasingly worried what's going to happen with these Chinese EV makers. Again, I think they have a lot of technology, how they got it. They developed very quickly. They have a lot of the raw resources. The batteries are being made there. And I think they are actually treating EVs a little bit differently than we do. They don't treat it necessarily as a vehicle. They're treating it as an appliance. And I think the features that go along with that are very different. So I'm really concerned that that's going to be an area where China does this made by China, and their brands start selling globally against ours.
You basically can't make an EV without touching China. You said they own all the raw materials, they own the processing for the raw materials. At what point do you think China just says, we are no longer going to sell you the battery, you have to buy our car?
You know, I think that's a real risk, or they start upping the price of that, because we have done such a poor job. We've seeded so much of the refining of these raw materials, then the processing, then the making of these components. We're going to have to get that back. I think long term that's going to be great for the U.S. I think we're going to see, you know, I think the foundries, the chips that we were talking about earlier, that is awesome that we're building these domestic foundries. That is going to be great. In the meantime, I think it's very inflationary and it's problematic.
Stock is down by 0.9% just on Tesla in early trading. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shanali Basak. Hey, Shanali.
Good morning, John. The U.S. is expected to announce sanctions on more than 500 people and entities linked to Russia's war machine. The announcement comes a week after the death of Russian opposition leader Alexei Navalny, and as the war with Ukraine approaches the 2-year mark. The U.S. and its European allies have already imposed significant sanctions affecting large swaths of the Russian economy and prominent officials. And Standard Chartered beating profit expectations, unveiling a $1 billion buyback plan. The bank saying its new Fit for Growth program will save about $1.5 billion in expenses over the next 3 years, but expects to spend about that much as it makes organizational changes. CEO Bill Winters has been looking for ways to boost returns for investors and jumpstart the stock, which has fallen over 15% in the past year. And Reddit filed for an initial public offering, revealing the social media platform's shrinking losses. The San Francisco-based company filed with the SEC more than 2 years after submitting its plan to file confidentially, and it's expected to be one of the biggest IPOs of the year. It would trade under ticker RDDT. That's your Bloomberg Brief, John.
Shanali, thank you. Appreciate it. Up next on the program, the Fed in no rush to cut rates.
It is appropriate to be patient, careful, methodical, deliberative. Pick your favorite synonym. But whatever word you pick, they all translate to one idea. What's the rush?
What is the rush? That question up next.
I love music.
Equities on the S&P 500 unchanged here after a big lift in yesterday's session. Yields higher again, lifting up by a single basis point, a 10-year 433.47. Under surveillance this morning, the Fed in no rush to cut rates.
I do believe that we may be in the position to see rates decrease this year. But I would caution anyone from looking for it right now and right away.
We have to be careful, and we have to try to assess the different shocks that can hit the economy.
I would like to have greater confidence that inflation is converging to 2% before beginning to cut the policy rate.
And it is appropriate to be patient, careful, methodical, deliberative. Pick your favorite synonym. But whatever word you pick, they all translate to one idea. What's the rush?
What is the rush? Here's the latest. Fed officials reiterating the central bank is in no rush to ease. This is US outperformance and NVIDIA push stocks to new all-time highs. Jens Nordvik of Exante Data writing this. The Fed is unlikely to set policy based on NVIDIA earnings, but the AI trend is part of US growth outperformance. And this outperformance has proved more persistent than many expected. The signal today is that this bullish trend is alive and well. Jens Nordvik, I absolutely love this note. So let's go straight to that quote. Jens, should they set policy based on what happens with a single name driving a monster move in this market?
I think the way I would answer is that I've never seen a company where I have to watch the earnings release for like literally what macro markets are going to do. So we've been doing this for 3-4 quarters now. We look at the line item in NVIDIA earnings release, right? That is the data center revenue item. And that is a proxy for what AI investment is doing in the United States in particular. And if you kind of scale it with the other investments that companies have related to AI, it's not just the compute, right? We're probably around 1% of GDP, and we've grown from 0 to 1 in a relatively short period of time. So this is a meaningful contribution to GDP growth in the United States. And when you look at how the U.S. economy has been doing over the last 3-4 quarters, it surprised a lot of people, and especially relative to what's going on in the rest of the world, where China is in serious trouble. Europe has very weak growth. It's very impressive performance. And this is something that you cannot ignore. And it's not just for NVIDIA traders, it's really for everybody. And you can see what's happening in global markets, right? We have interest rates rising, as you pointed out earlier today, and the equity market is still okay. And it's because there is this growth support, and it's a really important part of the story.
So given that, put it all together, let's talk about the balance of risk. The risk of cutting too soon versus holding too long. Which one's the greater risk?
So I think there's two things. So we already went through the AI dimension that's clearly adding to U.S. growth in a meaningful way. I think the other thing that we have learned this year is that we had very good inflation numbers in the second half of 2023. And now going into this year, we have this kind of annual reset process that we've seen around the world, where the first couple of months of the year is really impacted by a lot of, companies resetting prices on an annual basis, certain categories that don't move around very often, but they move around early in the year. And we've seen that again. And that is causing some uncertainty for the Fed. And it means that trend that you had in the second half of last year in inflation is not nearly as clear now. So I think that means that they have to be more cautious. And we're not seeing a lot of evidence that financial conditions are tightening dramatically, right? That was in October last year. Right now, financial conditions look to be on an easing trend, right? So what is the rush? There's not really any particular rush, right? So the people who really want to cut rates are the more academic types that look at a Taylor rule and say, okay, given where inflation is, we don't need to have 5.5% interest rates anymore, because that would really tailor to when inflation was very high, right? But it's a very academic argument. And I think given everything that's going on in the data, it's going to be the more pragmatic fraction within the FOMC that's going to win the debate right now and say, let's chill out, let's get more data before we make a too rushed decision.
Yeah, I think your AI point's great because it's really contributed to the U.S. Europe has such strict laws around data usage that I think they're going to struggle in AI. And what's really interesting, I don't know whether you saw it here, but Virginia's announcing some AI policies. I think you're going to see states compete for AI just like they competed for manufacturing. So I think it's going to be part of the long-term growth. It's going to change the industry here. So I think you're spot on that. Do you think the Fed does something maybe with the dot plots? How do they get this messaging a little bit more severe? I think everyone seems to be listening to the messaging, but not following through. What do they do next to really hammer your idea home?
Well, so the first thing I would say, right, is that interest rates had such a massive move from October to December that we got well ahead of the dot plot that the Fed has communicated, right? So the old dot plot that they announced kind of still is broadly consistent with the current market pricing, right? So really the market has come back to that dot plot message. So I don't think they necessarily need to tweak the short-term dots that much. But the big debate is what happens with the long-term dot, right? Is there something going on in the economy more structurally that means that we can have higher for longer, right? So the Fed has been reluctant to go in that direction, right? But as we get more and more data and as the AI boost proves to be more and more persistent, there's going to be more of a debate about whether they need to raise what they think is the long-term level, the long-term equilibrium, or star, if you will. And that's going to have an impact on how the market prices the trajectory of rate cuts, not just when the cuts are going to start.
Jens, truly, just an absolutely brilliant note, a fascinating read. I'll read it all through the weekend again as well. Thanks for joining us, Jens Nordvig there of Exante Data and Market Reader. Thank you. Pete, just a final thought on that. The long dot. What on earth is sufficiently restrictive? What is long-term neutral in this quickly evolving world?
I don't know, but maybe it is much higher than they thought. It's really nice to see that we're at 4% some odd, 5%, and the economy's still moving along, right? got sick as an investor, the whole ZERP, and you're looking at your retirement planning. It's hard to plan retirement when you're getting 0.0% on your savings.
Yeah.
So I think it's interesting. It'd be really encouraging if they do this. I really want to see a steeper yield curve. I think we go back to 2s, 10s being flat to like slightly positive sloping by the end of this year.
This is your big call. Higher yields. Peter Schiff, fantastic to catch up with you, sir. Appreciate it. Coming up next on the programme, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, Earl Davis of BMO, Amy Wu Silverman of RBC, joining us in the next 60 minutes.
There does seem to be more hesitancy than we thought there was at the Fed to start rate cuts.
I think the Fed is going to really be pushing back on the timing and magnitude of the rate cuts.
Our own view is June. I think markets are broadly in line with that.
We've been consistently calling for the Fed to be cutting in June. Our base case is that remains.
The best way for the Fed to proceed is gradually. The last thing we need right now is confusion in financial markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning. Good morning. This is Bloomberg Surveillance. Your equity market on the S&P 500 just slightly positive on the S&P. What a run we've seen over the last few days. We begin this hour with a record-breaking week. Nvidia, one name making up a little more than 4% of the index and almost 100% of the enthusiasm to buy stocks in the last 24 hours. That single name adding $276.65 billion in market cap in a single day. A single day. That's a new record. The old record belonged to Meta, and that was only 3 weeks old. The move wasn't just isolated to just one stock, one sector, or even one country. It was enough to help push equity markets worldwide to record highs. Stateside, the S&P, all-time high. The Nasdaq 100, all-time high. In Europe, the Stock 600, all-time highs. Germany's DAX, all-time high. Even in Japan, we reclaimed a milestone going back to 1989, the Nikkei 225 at all-time highs. This is happening with negative GDP in the UK, negative GDP in Germany, negative GDP in Japan, and interest rates in America at multi-decade highs. The stock market is evidently not the economy, and high interest rates have done little to dampen the enthusiasm to buy equity. Some are confused. Marko Kolanovic of JP Morgan saying we find current market developments odd. Others are nothing but jubilant. Dan Ives of Wedbush says this is a game-changing moment for the tech bulls and puts jet fuel in the tech bull market thesis as the derivatives of AI play out over the coming 12 to 18 months. To discuss a week full of records, I'm pleased to say we're joined by a good friend of this programme, Mohammed Al-Erin. Mohammed, what a week it's been. I just want your early response, your initial reaction to the price action yesterday off the back of earnings on one single name.
I think, John, is totally understandable. I think there is a revolution going on in AI, fed by four things that will only grow in importance, and that is computing power, data, talent, and financing. There's a very long runway, both on the supply side and on the demand side for this sector. On the supply side, we're going to see capabilities improving, expanding. On the demand side, it's not just about AI add-ons that a lot of companies are talking about today and trying to do. It is about developing things that are AI native. So when I look at this, I totally understand the excitement about the sector, and I totally understand how that sector can suck investment into many other things. So it doesn't surprise me. This is a secular story, John. Now, will there be excesses in parts of the market? Of course there will be. But there is something real going on that can enhance productivity and have a huge impact secularly.
You called it a secular story. Can we talk about the cyclical impact? Mohammed, we were talking to Jens Nordvig of Exante Data, and he was making the connection between what would happen to growth in America, to productivity in America, and how the Federal Reserve might have to reconsider how high rates might have to be in the years to come. Are you making that connection yet?
In years to come, yes, John, but this is not a Fed that has been basing policy on years to come. This is a Fed that's been basing policies on past data. It's been overly data dependent. But he's right in the sense that when working out productivity and growth potential, you've got to factor that in. It is a transformational, and it's not the only one, John. You know, you've been hearing me say there's three of them. There's what's happening to generative AI, there's what's happening to life sciences, and there's what's happening to green energy. And you've talked to my colleague, Michael Spence, on these issues, and you know how strongly he feels as well.
Spence was fantastic. I want to talk about the recent Fed communication we've had as well, Mohammed. Governor Waller, what's the rush? Do you share that opinion? What is the rush?
Do you remember when you repeated what I said a few months ago, when you asked me what's going to happen? I told you let me tell you what should happen and let me tell you what will happen. And I said at that time, 3 cuts starting in June. And that was at a time when the market was seeing 6 to 7 cuts starting in March. So we are now in a really good spot. We are now at a point where the market has finally converged to what the Fed has signaled. And it's really important to try and maintain that alignment because there's so much else going on. So I think it is right to say patience, but that communication shouldn't go too far. What's going to be hard, John, is to stick to the 3 cuts, both by the market and by the Fed, at a time when the inflation data is going to get much more bumpy.
Mohammed, what surprised me? I'll tell you what didn't surprise me. That spread closing, had to close. I'll tell you something else that didn't surprise me, how that spread closed. I was with you. The market coming towards the Federal Reserve. It's what didn't happen as that spread closed that shocked me. We've priced out all those cuts we had priced in since the end of October. We've pushed out the timing. We've reduced the magnitude of interest rate cuts this year. And yet still, this equity market's carried on rallying. The 2-year yield's up 50 basis points in just something like 3 weeks and change. And Mohammed, and still, this equity market carried on rallying. And if you'd asked me at the time, whatever my view's worth, back then, if we were going to close that gap in that fashion, if 2-year yields were going to reprice higher by, let's say, 50 basis points in 3 weeks, I would have said stocks down hard. Stocks are up. How do you explain that, Mohammed? How important is monetary policy to equity market pricing, given the dynamics in NVIDIA, in AI, in big tech?
You know, John, simply put, it's one of 3 factors. Interest rate risk, of course, has been a significant headwind, but you've had 2 very strong tailwinds. One we just talked about, which is the secular journey that we've embarked on, led by these incredible innovations. And then the second significant tailwind is the strength of the economy. You know, we were also surprised by a 3.3% growth rate in the fourth quarter. We were also surprised by an almost 5% growth rate in the third quarter. And the U.S. locomotive has been strong enough to offset the numbers you showed in terms of recessions in Germany, UK, and Japan.
Do you think that should lift all boats abroad, though? And you mentioned the recessions in the UK, Germany, and Japan. We've also got all-time highs in Germany and Japan. Mohammed, can you explain that just by the US alone?
Well, what you can explain it by is people looking at valuations differentials and seeing that other markets look incredibly cheap relative to the US and wanting to go fishing there as well. You know, a lot of people have been saying, well, if I'm going to invest at the US at these levels, just look at how much cheaper other markets are. So you're getting massive spillovers because people are looking at relativities, John.
Do you think those easing financial conditions should be of concern to certain central banks still grappling and lacking confidence of getting inflation back down towards target?
So you're taking me to the question that you know I don't really like discussing, which is what is the appropriate target? We're living in a world where, given everything that's going on the supply side, we're talking about geopolitics, we're talking about companies rewiring their supply chains, we're talking about what's happening in the labor market, that when you look at all this, if I was a central banker, I would be aiming at an actually long journey back to 2%. I wouldn't rush to get back to 2%, because in the back of my mind, I would believe, as I believe right now, that if I was to set an inflation target today, it would be higher than 2%. It would be closer to 3%. But of course, I can't change that because I've missed my target for so long. So I in the back of my mind, I would not be in a rush to force it back to 2%. And that's really important. If that is my mindset, then I can live with these financial conditions. If my mindset is I need to get to 2% really quickly and that's the right inflation target, then I would be concerned about financial conditions.
Well, Mohammed, we also have to acknowledge why you said that all that time ago. The reason you said that is because you believed initially that in order to get back to 2% and over, say, 18 months, 2 years, we needed to crush the economy to do that. The lesson of last year was that maybe we don't, perhaps. What's the question now that you'd be asking with regards to that? Do you think we can achieve that inflation target without crushing the service side of the economy, given the disinflationary trends that have emerged over the previous 6 months?
So let me give you my probabilities. I think it's about 55% probability that we can get towards a stable inflation rate that's low enough. It won't be 2%, but that's low enough and that's stable enough that it anchors inflation expectations without crushing the economy. I'll give that a 55%. I'd give a 30% probability that either because of an external shock, and there's a lot going on in the world right now, or a domestic political change, or a policy mistake from the Fed of staying too tight for too long, 15% that will slip into a mild recession. 30% will slip into a mild recession. And 15% is that the productivity gains that will occur over a number of years happen much more quickly. And then we find out that we get to what some people call the no landing, that growth stays incredibly robust while inflation stays well behaved.
Mohammed, Governor Waller yesterday was talking about they want to see a couple of months of inflation data to make sure that they're prepared for these cuts. You're looking at June. What needs to happen in terms of goods disinflation between now and June for you to be comfortable?
No, I'm comfortable now, okay? And I'm comfortable now because I look way beyond. I think that data dependency doesn't mean data obsession. It's very, very, very problematic if you get obsessed by data, because you need to look forward. Your measures act with a lag, as you know, Annmarie. So if you are totally basing policies on the last few months of data, you will get it wrong. And that is why we have had such a reactive Fed. That is why communication has been such a problem. So I don't need to see 2 more months of data to feel comfortable cutting 3 times starting in June because of what I see ahead. But if this Fed remains obsessed with being data dependent and seemingly solely data dependent, that they want to see goods inflation staying well tamed while service inflation coming down. That's what they need to see.
Mohammed, let's just finish this segment by asking a simple question. I know it's difficult to answer, but what evidence is there that they are sufficiently restrictive, looking across the economic data we've had, not over the last month, but over the last 12?
So borrowing costs have gone up. True spreads haven't gone up like everybody expected, but that has to do with the fact that credit risk has been supported by economic growth. Inflation has come down, and it's not just a supply side issue. We've seen major adjustment in interest rate sensitive sectors. So there is evidence that they've had an impact through higher rates. John, my concern honestly is that now the market and the Fed, surprised by the fact that the inflation numbers are getting more bumpy, will end up being too tight for too long.
OK, let's just go there again. Let me ask that question, Mohammed. You think the biggest risk here is that they hold too long, not cut too soon?
Correct. If they don't cut in June, then you'll hear me say, oh no, we're now making the opposite policy mistake that we made back in 2021.
Interesting. This conversation, Mohammed's going to continue. It's fantastic to have you with us. Mohammed Al-Arian sticking with us. Your equity market on the S&P 500, just about positive on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Sonali Basak. Hey, Sonali.
Good morning, John. ECB Executive Board member Isabel Schnabel suggesting that the Eurozone may have weathered the greatest impact of its interest rate hikes. Speaking in Milan, Schnabel saying, quote, our models tend to suggest the peak impact of monetary tightening may now be behind us. ECB officials will hold their next policy meeting on March 7th. U.S. crude oil exports have hit a record level, highlighting the pressure on OPEC Plus nations to avoid a global surplus ahead of its meetings next month. February exports hit 4.81 barrels a day, about 1 million more than a month ago. And OPEC Plus members are set to decide whether next month to extend voluntary output cuts of 1.9 million barrels a day. And the new sports streaming merger between Disney, Fox, and Warner Brothers could attract 38 million subscribers by 2032. And that's according to estimates by Citigroup. That would represent about half the U.S. households that like sports, with the bulk of those subscribers coming from cable TV customers cutting the cord for a cheaper alternative. The service is expected to cost between $35 and $40 per month. And that's your Bloomberg Brief, John.
Shanali, thank you. Up next on this program, a fresh round of sanctions against Russia.
The sanctions that we'll be announcing on Friday will be in connection both to the 2-year anniversary of the full-scale invasion of Ukraine and to Navalny's death.
Much more on this a little bit later. We'll catch up with the Deputy Secretary of the Treasury, Wally Adeyemo, 8:45 Eastern Time. That conversation is up next from New York. This is Bloomberg. Live from New York, we can take a breath this morning. It's a bit calmer following the big moves we saw yesterday on Nvidia and a broader stock market, not just stateside, but worldwide. Equity futures on the S&P totally unchanged. Yields up a single basis point, 433.47. The euro doing nothing at all, 108.26. Unchanged on that currency pair once again. Under surveillance this morning, a fresh round of sanctions against Russia.
The sanctions that we'll be announcing on Friday will be in connection both to the 2-year anniversary of the full-scale invasion of Ukraine and to Navalny's death. It will be a robust sanctions package. We are always looking at additional ways that we can choke off the Russian war machine.
It's the latest this morning. The US set to announce sanctions against more than 500 people and entities linked to Russia's war effort nearly 2 years after the invasion of Ukraine began. The sanctions will be the largest single package of economic penalties against Vladimir Putin's regime so far. Joining us now is Bloomberg's Michael Shepard down in Washington, D.C. Shep, I guess first question, what's left to sanction in Russia after the effort of the last 2 years?
That's a great question. There really isn't that much. You know, over the past 2 years, and I remember vividly as our teams were covering this in the aftermath, the immediate aftermath of Putin's invasion of Ukraine, just how big they went. They froze central bank assets of Russia that were held overseas, and they also booted several Russian banks from the interconnected network that helps to move financial transactions around the world, known as SWIFT. Those were considered seismic events when it comes to penalizing another country for its geopolitical conduct. And yet, even with those measures, we haven't seen much of a slowdown in Putin's war machine.
There's one place where they could go after that, for the most part, has been saved, and that's things like nickel and aluminum. Do you think this administration is going to take that next step?
We may or may not see that next step today. That remains to be seen. And they also have to calibrate very carefully what the ripple effect, not only in markets for Russia, but even more so elsewhere in the world. Any upset in the supply of precious metals, especially aluminum, could have unforeseen consequences when it comes to the domestic economies of the countries that are actually imposing the sanctions. And that's also a politically sensitive question back here at home. The U.S. is just starting to see inflation break and abate, and Biden is really trying to make sure that it doesn't flare back up because of some other outside event prompting that, such as sanctions in a sensitive area like aluminum.
Shep, you have Schumer going to Ukraine today, but he's showing up empty-handed for President Zelensky. What is the mission of this trip?
Well, that's a really good point, Annmarie. And the issue really for Schumer and for Congress, members of Congress who are allies of Kiev and really want to provide those reassurances, they just want to show that, look, we believe that this still can get through. We know it's been tough. Please hang in there. And yet, when you think about the calendar, the amount of time that has passed since President Joe Biden first asked for that $60 billion package back in October, in that time, the tide of the war has really turned against Ukraine and in Vladimir Putin's favor. And this is something that President Joe Biden, in a statement that he put out early this morning, talking about the sanctions and the 2-year anniversary of the war and the death of Russian opposition leader Alexei Navalny, this is something that Biden alluded to. He talked about it's not through sanctions alone we are going to be able to change the course of events in Ukraine. We also need the House of Representatives to actually pass this $60 billion package of aid for Kyiv.
Hey, Shep, it's good to hear from you. Michael Shepard down in Washington, D.C. on the latest effort to try and constrain Russia and the war machine. You know what the elephant in the room is here? It's the $300 billion in Russian central bank reserves that were effectively frozen back in 2022. What are we going to do with them?
It's a great question. These reserves, some people are saying potentially if there's going to be an opening to have a peace negotiation, does the U.S. use this as a carrot and stick approach? This is something that everyone says amongst all the sanctions that's been levied on Putin, this is the one that hurts the most.
Mohammed Al-Erian's still with us. Mohammed, we don't have to talk about this directly, but more broadly, the world becoming a more fragmented place. You and I have been talking about nearshoring, friendshoring, deglobalisation over the last few years. When you look at those themes, Mohammed, does that still contribute to your idea that this is going to be a regime post-pandemic that has higher inflation, more volatility than the one we had before the pandemic?
Yes, absolutely, because you have two distinct factors. You have first the non-commercial determination of supply chains for geopolitical reasons. And then you have a second factor that's coming in as well that tends to aggravate all that, which is the continued weaponization of economic and investment tools for the purposes of national security, which is totally understandable. But both these tend to be inflationary. John, I think the biggest surprise, including for me, is that the Russian economy did not suffer as much as most of us expected. Did not suffer in terms of the contraction. There were projections of 10 to 15% when Russia was thrown out of SWIFT, when the sanctions were put on. And the IMF in its latest projections increased growth for this year in Russia to over 2%. And that tells you two things. One, that with hindsight, the West should have been much harder on the sanctions, fewer exceptions, and taken the risk of collateral damage that you just heard Michael talk about. Because the second issue that does is it signals to the rest of the world that maybe you can live outside the Western system. Well, that is not as much as a threat as most of us thought it was.
Well, we were talking earlier with Peter Cheer about the fact that Russia just created new markets. India and China is where they now sell all their energy, and Europe at one point was one of their biggest partners. So in that sense, Mohammed, have sanctions actually worked?
So not only have they created new markets, Annmarie, that created new payment systems that bypass the dollar completely. And that is, I think, what has surprised many, including me. The Russian technocrats working with others have come up with this very clunky system, but nevertheless allows for international payments without going through the core of the system, which is this image of little pipes being built around the core. And the worry is that you're going to encourage more people to build these little pipes. So that's the fragmentation of the economy. Look, there was a decision to be made early on about how hard are you on energy? Should you threaten secondary sanctions or not? And for the reasons that Michael pointed out, the decision was don't go that far. And therefore, sanctions are as effective as the sanctions you employ. And there were two major loopholes left in round one.
It's hard to know the answer to the following question with any certainty, but let's just explore it anyway, Mohammed. The elephant in the room. If they confiscate those Russian central bank reserves that were frozen 2 years ago, how concerned would you be that other countries would begin to ditch Western currencies?
I think other countries would look at that very carefully. Look, John, in economics, there's always this notion that says, make sure that you have enough tools to meet the number of objectives you have. And we are pursuing sanctions for three objectives. One is to punish Russia. Two is not to excessively harm the global economy. And three is not to excessively harm the role of the dollar in the global system. And you cannot get these three objectives with just a single tool of sanctions. And that's why you hear, sanctions are not enough. But the risk is that you end up trying to pursue all three using a single sanction, and then you end up with not satisfying any of the three.
Hey, Mohammed, this was great. Just awesome to catch up with you. Good friend of this programme, good friend of mine, Mohammed Al-Erian of Bloomberg Opinion, weighing in on the Federal Reserve and the sanctions regime of the United States trying to clamp down on Russia. Later on this morning, 8:45 Eastern Time, Wally Adeyemo, the Deputy Treasury Secretary, facing some of those questions a little bit later on this programme. Up next, Earl Davis Abimo, as we look ahead to key inflation data next week that could influence the Fed. Live from New York City, Mike McKee dropping around a table to get you up to speed on some Fed speak. We'll do that in just a moment. Equity futures on the S&P 500 right now, just about positive by 0.06%. Decent week of gains, massive day of gains yesterday. Biggest daily gain on the S&P 500 back to January 2023 off the back of a single name. Just unbelievable. All-time highs on the S&P, all-time highs on the Nasdaq 100. Let's see if we close at those all-time highs going into the weekend. This Friday morning, your bond market shaping up as follows: a 2-year, 10-year, 30-year, 2-year, 471.33. Go back to the end of January. Look at the chart. The day of the Fed's last meeting. At the close then, we were looking at 420. We've repriced higher by more than 50 basis points. In a moment, we'll catch up with the man who predicted this, was looking for that repricing at the front end, why he's closed out that trade, and why he is still looking for higher yields at the long end. Stay tuned for that. 432.48 is where we are on the 10-year right now, and a 30-year just about unchanged, 446.19. In Europe, the German IFO, business confidence, not as bad as some people expected. We're doing okay on the euro, slightly stronger by 0.1%. Euro dollar right now, 108.35. Under surveillance this morning, Fed officials reiterating their stance that rate cuts are coming this year, just not anytime soon. Governor Chris Waller, among a slew of recent Fed speakers, saying, quote, "The data we have received on inflation mean it is appropriate to be patient, careful, methodical, deliberative, whatever word you want to pick. They all translate to one idea. What's the rush?" The comments coming as Goldman pushes back its call for a first rate cut. Jan Hatzius and the team now calling for a rate cut in June. It was March, it was then May, and Mike McKee, now it's June. And they're not alone. They're pushing it back, and they're pushing it back.
They are pushing it back. It's almost as if it was coordinated. One of the things that drives Fed officials crazy is the idea that they coordinate their communications, because they really don't. But in this case, everybody has the same song to sing, and it's, we're not in a hurry. We want to make sure we get this right. And with the economy the way it is, growing at the rate it is, with jobs growing the way they are, and inflation still coming down, even if fitfully, what's the rush?
Mike, credit to Fed officials so far this year, and I think you and I have talked about this repeatedly. The incoming information has surprised, but it's led markets, economists to readjust their expectations. For Fed officials, they can still sit here and say the dot plot is still intact from the end of December, can't they?
Yeah, well, remember, the Fed changes its forecasts once a quarter, every 3 months. The market changes its forecast every 5 minutes based on new incoming information. And then the market changes back because something else happens. So the Fed can sit there and say, well, we're going to look at a much longer period of time before we start switching what we're doing.
Well, Waller was talking about a couple of months he wants to see this inflation data. And we asked Mohamed El-Erian, he says they've become data obsessed. Do you think they've become data obsessed and they risk making an error?
I think Mohamed is a little bit overboard there. I don't think they're data obsessed. It's how they judge the economy. But I think what they're looking at is inflation. And I noticed he was talking about where he thinks they're going to be. And that's what they should be looking at.
Yeah.
That's what they're doing as well. That's why they're saying a couple more months, because they think in a couple more months we'll get to the point where inflation is low enough. But they are watching on a day-to-day basis. And you go back and you look, and I was just doing that this morning. Jay Powell has been saying the inflation progress is going to be bumpy for months and months and months. So the Fed's not surprised by this. And as you noted, John, they haven't changed their forecast. They're still looking at a couple more months. They're still looking at 3 cuts because they anticipated it would be this kind of a process.
Mohamed had something to say on the balance of risks, and I wonder what your thoughts are on that, just based on what you're hearing from Fed officials so far, that he now believes the biggest risk is holding too long, not cutting too soon. How well shared is that view on the FOMC at the moment?
The Fed has basically come to the conclusion that they can hold as long as they need to. They're not worried about a recession at this point, but they also realize that they don't want to wait too long, which is why they're still looking at 3. Now, the thing I was thinking about when Mohamed was offering his opinion on that, and I heard him talking about it, and he brilliantly supports his view, he's one guy. And that's the situation with the Fed. There are 19 of them, and some may have that view. You know, Mickey Bowman's been very hawkish.
Sure.
And so some may have that view and others don't. And they've got to come together as a committee and make a decision.
I can't get a sense of how split that committee is right now. When we go back to the news conference with Chairman Powell, a takeaway of a lot of people, I remember Lisa said it at the time, that it felt like the chairman was struggling to herd cats on the FOMC, at least struggling to come up with a consensus to sort of communicate to the audience. And then I listened to the Fed officials. I don't see a massive difference between the Fed officials right now. Mickey Bowman to the one side, I sort of know that she's pretty hawkish, Mike, but everyone else feels like a difference in degree and not in kind.
I think you've got it right. I mean, there's two things at work here. One is that they don't have to make a decision now. So why lean strongly in one direction or another, especially if you know how the markets are going to react to that? And two is they genuinely aren't sure at this point, and they don't have a reason to make themselves sure right now. They're going to wait, and they're going to see what happens with the economy. We get, before the June meeting, we'll have like 3 or 4 more PCE inflation numbers, and we'll see if inflation continues its progress.
That's the Federal Reserve. I want to turn to this story as well and get you up to speed on the latest in Israel. The Prime Minister Benjamin Netanyahu agreeing to send negotiators to Paris for talks with the US, Qatar and Egypt on a new hostage deal. That's according to reporting by Axios. President Biden has been increasingly vocal in pushing for a new deal between Israel and Hamas, with the White House seeking an agreement that would include at least a 6-week pause in fighting. Annmarie, how big a change is this from Netanyahu?
So I struggle with this story because I really feel like it's Netanyahu placating to the U.S. administration that has been putting a tremendous amount of pressure on them to negotiate for a hostage deal, because this is what Benjamin Netanyahu said in a brief phone interview with Bloomberg this week. Quote, I ordered a plan, they're preparing it, and we are going to present it in the near future. Not a plan for hostages. Determined to push ahead with going into Rafah.
And the pressure right now building on who in a bigger way? Him or President Biden? President
Biden. We're very close to a November election. Michigan is where you have a lot of the diaspora of Palestinian Americans living there. I think I talked about this before, Jonathan. You look at people who voted for Biden in 2020. They're now saying they are, quote, abandon Biden is a slogan for some of these people in Michigan. And they're not saying they're going to go out for Trump, but they're saying they're not going to go out and vote. Hillary Clinton lost Michigan by 10,700 votes.
Yeah.
When you're looking at such slim demographics like this, that you need to make sure that you're reaching, this is where there's going to be a lot of challenge. And that's why you see Biden putting that pressure on Netanyahu.
We're talking about really, really narrow margins. I want to turn to this story as well. For those of you that wake up really early, maybe you leave the house at about 3 a.m. in the morning and you were connected to Wi-Fi and thought you had the internet. Then you got outside and realised you don't have signal. You weren't alone. AT&T had some problems yesterday. The FBI and Federal Communications Commission are investigating cell phone outages on AT&T and other networks that left thousands of Americans without the ability to send texts or place calls yesterday. The outages have been restored since, with White House National Security spokesperson John Kirby telling reporters they're in contact with AT&T and don't believe the disruption came from a cybersecurity incident. But AMH, people were asking that question quite a few times yesterday.
Well, I know you have AT&T, so I'm not sure if this is personal for you. But what AT&T is saying that is a processing error. So at the moment, they're ruling out cybersecurity. But officials privately are not ruling out cybersecurity and cybersecurity hack potentially from China. So you have the FBI looking into it, Homeland Security, the FCC looking into it. This is top of mind for them. I think Peter Cheer brought up a great point. When you think of cyber hacks, you think of digital, wiping all the customer data from a company. No, the issue when it becomes a big problem for any government is when it hits infrastructure. You think back to Colonial Pipeline, you think about the U.S. administration's concerns about China operating 80% of the cranes at U.S. ports, and now we have an outage at AT&T.
One of the things that you could say about this is it's maybe, in a way, good news because it gets people to focus on this even more.
True.
I would point everybody to the great op-ed that Admiral James Stavridis wrote on Bloomberg yesterday, pointing out that the biggest danger, everybody's talking about Russia and the nuclear weapon in space, but that China or Russia or some other enemy cutting undersea cables would be even worse because much more traffic goes across that. And we tend to think of it in terms of John can't call an Uber or that we will lose our spy satellite capability. But the financial markets depend on this stuff.
Yeah.
And if they cut one of those cables, we'd have a global crash. And so this is really important to be focused on, not saying that the appropriate people aren't focused, but it's always a good reminder.
Without a doubt, this is far more important than my Uber. This wasn't personal. Mike McKee, thank you. It's good to see you. I want to talk about this bond market. We've seen some really big moves, and certain people have just got a really good read on things this year. One of those is Earl Davis of BMO Asset Management, calling for a further sell-off in the 10-year Treasury yield to 450 to 475, saying he believes then it might well be a buying opportunity. I'm pleased to say that Earl joins us now for more. Earl, you've been fantastic, so I'll say it for you. Just congratulations to a wonderful start of the year. If I just chop up the yield curve just a little bit, and we'll start with the front end and we'll move further out to the long end. On the front end, you talked about a repricing. We've had one of about 50 basis points. I understand you've closed out that short. So before we talk about the long end and the prospect of yields going higher, why the change at the front end?
Yeah, well, it's been a fantastic move, 50 basis points in the last 2 weeks. So we closed it out. And the reason is we're about the meat, not the fat. So we got the meat of this move, not to say it can't go towards higher yields, but that would be the fat. And, you know, I've been in the market 30 years, and you know what having too much fat does for the body. So we're good where we are right now, and we're looking to switch our risk.
Don't get greedy. So let's go further out along the curve. Why are you looking for that move from, say, 450, 475 from, I think, the 430 we're at right now?
Well, what's interesting is when the 2-year bond moved 50 basis points higher, the 10-year bond moved 15. And there's several reasons for that. One is, you know, people are focusing on a repricing of the cuts and when that begins. But also, a lot of people had curve trades on. They had what you call a bull steepener. They were long the 2-year bonds, short the 10-year bonds, because that's typically what happens when you get the rate cuts. So because they had the bull steepener, they had to unwind that trade. They had to reverse it, take their losses, which meant they accelerated the 2-year bond sell-off because they had to sell the 2-year bonds that they owned, and they bought 10-year bonds. So they muted that sell-off. So now we feel that covering is largely done. And the focus, we got 3 data points that the market will focus on: PCE next week, unemployment the following week. But the week of March 12th, we have the next 10 and 30-year bond auction. We think that's going to come back into focus over the next couple of weeks. And that's what we think will push yields out to above 450 to 475. So we're setting up in that area in regards to underweighting duration there.
Let's talk about those auctions. Is it the size of them, or is it just that a high yield sometimes begets a high yield because the fear starts to kick in and then you refocus on the size of the auctions again?
Yeah, I like to say it's the size squared because it's the size of the individual auction. But remember, these are cumulative. This is the second one for this year. There's going to be many more. And that's what's weighing. That's taking out the marginal buyers, people who had to get long in the first auction got long. They might be done for the year if they're a big pension plan or insurance company. Now we'll see who wants to buy the second auction. So it's the cumulative effect of these large individual auctions that are pushing yields higher.
Oh, that point on where the buyers are and who they are, I think is so important. We've had people come on this programme and describe this wall of yield-hungry money that's going to come into the 10-year of 450 and buy it and buy a lot of it. Are you pushing back against this idea then?
No, I do believe there'll be some buying. We're going to be buyers, you know, 450 to 475. We think it makes sense. And the reason why we think it makes sense, you know, when I was on your show late last year, we said our expectation for 2024 is that we're going to test both the high yields of 2023, you know, that move towards that 5%, and the low yields, you know, that's that move towards, you know, your 325. We still believe that. We still believe we'll have lower yields by the end of the year. And we think because of the sell-off, this makes a great buying opportunity, you know, from a valuation perspective compared to 2023. The thing I like to say is valuations are not a timing tool, which is why we're tactically short now heading into the auctions, and we'll come out long.
I loved your note. It was a great read, and you acknowledged the risk factor, the number one risk factor to your big call, which is ultimately the labour market. Earl, any reasons to believe that we would get any kind of deterioration in the labour market anytime soon, given where jobless claims came in earlier this week?
That's one thing where we do not see any deterioration coming. And the number one reason why is just the fiscal deficits. There's still a lot of money hitting the economy, and that money is going to private sector. So I think, you know, each time you get a very strong number, a resilient number, it adds confidence to small and medium-sized employees that, you know what, maybe this will be persistent. So we feel it'll feed upon itself. It'll be stable, it'll be strong for the first half of the year. And then, as we said before, we feel inflation will come back up second half, and that's when you start getting the pullback in employment.
Oh, you talked about auction squared. Can we just finish on that? And the budget deficit too, which is why maybe this labour market is supported through this year. This isn't going away anytime soon. When you listen to the political analysis, you hear what is told to us down here in the United States is that ultimately it doesn't matter who takes control of the White House. That deficit's going to be big, it's going to be large, it's going to be persistent. When that all starts to accumulate through next year as well, doesn't that push back against this theory that yields are ultimately going to drop back to where maybe they were a few years ago?
Yeah, and for us, we believe that, but the market takes time to adjust to it. And the market has, I'd say, both short-termism and extreme short-termism. And what that means is they look at yields over the past 15 years and they say, oh, these are great yields. And they buy, and the market rallies like it did the fourth quarter. But then it pulls back and tests the highs for exactly the reason that you said. This is going to be a secular trend towards higher yields. If you look at the average of 10-year yields from 2000 to 2008, basically, it was 475. The long-term average is 475, and we have a long-term range of 6% to 3%. We believe that still holds, and the dynamic that we have now is a slow grind higher up towards that 6% over time. It's not a 2024 story, maybe a 2025, but we don't feel that. But it's a 2027, 2028 story.
Earl, this has been amazing. Thank you, sir. Congratulations once again to you and the team for a really strong start to 2024. Earl Davis there of BMO Global Asset Management. Just to give you the scores, just briefly, we're down about a basis point on the 2-year, 470. Bear in mind, we've had this move from 420, so 50 basis point move higher at the front end. So Earl and the team have closed out that short. The 10-year now at about 431, 32. They're looking for a move to, say, 450 to 470. Earl went through the auctions for next week. Just a sneak peek of some of the size, if you want the size. 2-year notes, $63 billion worth next week. 7-year notes, $42 billion worth. And they're going to keep coming over the next few months. That's the price section in the bond market. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Sonali Basak. Hey, Sonali.
Hey, John. Warner Brothers Discovery missed on revenue for the fourth quarter in earnings posted this morning. The media company says last year's writers and actors strikes weighed on television, posting a 20% decline in content revenue. However, Warner Brothers Discovery did see a beat on total subscribers with nearly 98 million customers. CEO David Zaslav added that the streaming service Max will be rolled out to new international markets. And for the first time since 1972, the U.S. is back on the moon. Intuitive Machines landed a robotic spacecraft nicknamed Odysseus on the moon's surface Thursday afternoon, and it's the first private firm to successfully place a vehicle there. Following landing, NASA's administrators said in a webcast, "Today is a day that shows the power and promise of NASA's commercial partnerships." And the huge rally in NVIDIA shares has catapulted CEO Jensen Huang to new heights. He is becoming one of the 20 richest people in the world. Huang's wealth jumped $9.6 billion yesterday to more than $69 billion, and it's a gain that leapfrogged him ahead of Charles Koch to 21st place on the Bloomberg Billionaires Index. And that's your Bloomberg Brief, John.
Sonali, what a run. Just unbelievable. Sonali, thank you. Up next on this program, the AI rally goes global.
This was kind of, to me, it's almost the last gasp. Everyone now who was caught short, everyone who was uninvested is pulling in.
They've been piling in over the last 24 hours. That conversation up next. This is Bloomberg. Live from New York, equities just about positive on the S&P 500. Little bit of a lift after a big lift yesterday on the S&P. Changes to some yield forecasts for you. This from Jay Barry over at JP Morgan. The 2-year, their forecast was 325 for year end. It's now 380. 10-year was 365. It's now 380. 10-year right now is 431. 2-year is now 470 something. Under surveillance this morning, the AI rally goes global.
This was kind of, to me, it's almost the last gasp. Everyone now who was caught short, everyone who was uninvested is pulling in. And I understand what's going on. We really like AI. We believe AI is going to change things. The problem is, did it get too expensive? Is the data ready for AI? And if it's really going to work, the rest of the market has to be successful.
Here's the latest this morning. Equities around the world hitting all-time highs as Nvidia adds about $277 billion to its market cap in a single day. Amy Wu-Silverman of RBC Capital Markets writing, quote, "It has been tough being a bear these days. Post Nvidia earnings, history would suggest that positive momentum will beget more Momentum. Amy Wu-Silverman joins us around the table in New York. Amy, good morning.
Good morning.
Before we get to the momentum, can we explain what on earth yesterday was? We were speaking to Pierre Ferro of New Street Research a little bit early this morning, and I said to him, if I'd said to you that their revenue forecast would be $2 billion above the street, would you have guessed that the equity market would rally as much as it did yesterday? He said no. What on earth was that?
So look, when we look at the derivatives market, the one thing that we were telling clients prior to NVIDIA earnings was that the call exuberance, so the demand for call options relative to put options, was at historic levels. The last time we saw this kind of positioning was May of 2023, and we know what happened there. So look, it is typical, I think, to blame options when you don't have any other good reasons, but I do think it provided a tailwind, and there are other technical dynamics that follow options, like the dealer positioning that happens, the gamma cycle that happens. But we've seen this over and over again post-COVID, where options plays a very large role in exacerbating momentum.
We just quoted you, and you talked about positive momentum begets positive momentum. Why is that? Is that what you're expecting now to develop?
Yeah, you know, when we look back at financial history, I think one thing we'll say is that post-COVID is really its own block of time, almost its own regime, because a lot of the options relationships we're used to have broken down. So now we see spot up, volatility up. And this really started during the meme craze, where people were reaching for upside. They put one toe in the pool and they said, I'm ready to jump in. And this is what we're seeing. It's a way of expressing FOMO, but on an institutional scale, because this is not just retail investors. It's folks who perhaps came in underpositioned and feel like they must participate because no one really knows what AI could mean in the future.
Back then, we had a ton of fiscal stimulus, rates were zero, and we had QE. Now rates are 5.5%, and we've got QT. Are we de-emphasising the importance of monetary policy? Should I spend more time listening to Jensen and less time to Jay?
Yeah, you know, it's a great question. I think on the longer tenors, yes, but on the shorter durations, no. I think on the shorter durations has really come down to the fact that these tactical positioning and options matter much more. I think that's what we see in these exacerbated moves. And that's why I think following this exuberance now still matters a lot. And it's still telling us, actually, that there is more positive momentum to go.
What is the correlation between rates and stock markets right now?
You know, it's interesting. I think when you look to the rest of the market, so ex Mag 7, it does matter a lot, and you do still continue to see that. But one thing that we've talked about is historically TLT and SPY, where this inversely correlated bond equity correlation we could all count on, that has also broken down, and Mag 7 has almost taken its place. And just hear me out, this, I know it sounds crazy.
Sure.
But it's almost taken the same inverse correlation. When you have a flight to safety, where do you go now? You go to Mag 7. It's almost operating as its own bond equity portfolio. That's what I think is very interesting when you think about the context of rates.
Do you think other people are picking up on that?
I think so, and I think they're trading it, and I think that's why, you know, you have this breadth of the market where, sure, it looks great. All the headlines talk about NVIDIA, but the reality is, you know, a large percentage of the market didn't rally yesterday, and that's the problem. It's the breadth of the market is really overwhelming what you see on the surface.
Can we talk about risk events on the horizon? Something you and I talk about a lot. What is the big risk event on the horizon now, given what is the dominant factor behind this rally?
So it's interesting. I think that obviously anytime we have any sort of Fed speak, that has importance, obviously. But March 18th is the next time NVIDIA will have an AI conference. And I actually think that's a very important inflection point in the market, because when you have this momentum cycle, you need a clearing event either to make it continue or to make it break down. So that's what I'm watching for right around options expiration as well, where I think it's going to be important to see where the momentum goes or whether or not it flags.
Anyone buying any protection on a government shutdown, or just no one cares?
Sadly, no. But I will tell you, you know, look, I've been digging around in my financial history, and you go back to 2011, debt ceiling crisis, VIX did spike to 35, and it was sustainably there through the remainder of the year. There are obviously other things going on economically, but there is not lack of precedent for government shutdowns, debt ceilings, election events to be very important to volatility. I will just tell you, it's not what's on the market's mind right now.
Nobody wants to talk about politics. I'll go back to your colleague. I always quote Laurie Calvasina of RBC, who described talking to clients about the election this year as staring at the sun. And that's what it feels like. That's what it feels like for a lot of people.
Well, Amy, your notes was, quote, I guess we have to try and talk about it, huh? That's the sentiment from clients. Because this election, we pretty much already know the front runners. They have to, at some point, start thinking about it, I'd imagine.
Yeah, look, it's sort of the longest general election, and I think for a lot of investors, what I have gotten feedback on, I think this is interesting, is that there's actually been very little policy talk. So all the policy talk has just been, essentially one and the same, and it's been hard for people to focus on sectors that way.
True. Amy, it's good to see you. Thanks for being with us. Amy Silverman of RBC Capital Markets with some really thoughtful stuff. Next hour, Jay Pawlowski of TPW Advisory, Andrew Sliman of Morgan Stanley, Rob Socket of Citi, and US Deputy Treasury Secretary Wally Adeyemo. The third hour of Bloomberg Surveillance up next.
I think the equity market's sort of really nicely sort of set up from here.
There's lots of opportunity within this market.
But this overall tech market, to get out the popcorn movement.
Even at rich valuations, it is going to be earnings growth that is going to drive the market.
We're starting with the Magnificent Seven, but over time we see the gains and the positivity spreading.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
One more session until the weekend. Live from New York City this morning. Good morning for our audience worldwide. What a week we've had. This is Bloomberg Surveillance with your equity market on the S&P 500 slightly firmer. Bramo's out. We've got a treat for you for the next hour. Jay Pawlowski of TPW Advisory. And Jay was running around the desk this morning, just doing laps, victory laps. Jay, let's talk about it just briefly. All-time highs in Europe, all-time highs in Japan, in France, in Germany. You were looking for these moves. You were looking for a move in China. I was laughing about it. Now we've got a 9-day winning streak.
Yes,
over
exactly.
On the CSI 300.
Thank you for mentioning it before I did.
I was going to remember it.
Because I was going to mention it first.
I had no doubt you would. Let's talk about it. You're feeling good. What's behind it?
Yeah, no, I think there's, look, we've made a handoff from depending on rate cuts to earnings growth. And that's the big story behind all the new all-time highs. The other point that we want to make is that we've removed the inconsistency that we had in the markets, where the markets were expecting both 7 rate cuts and 10% earnings growth. Those two things don't go together, right? So we've been able to squeeze that 7 rate cuts down to 3 or 4 in line with the Fed with not any pullback whatsoever. And to me, that plus the fact that we're having global new all-time highs means this bull has got some legs.
It's been truly impressive to see this repricing at the front end of by 50 basis points on a 2-year, and the equity market just carried on going. We're going to talk about that in just a moment. Equity futures right now more broadly on the S&P going absolutely nowhere. In the bond market on a 10-year, yields look a little something like this. So 430, 130 right now. Earl Davis Abimo on the programme with us a little bit earlier, looking for 450 to 475 over the next few months. So that's one to look for. In the FX market, the euro just a little stronger, 108.32 on that currency pair. Coming up on the hour, alongside Jay, we'll catch up with Morgan Stanley's Andrew Sliman on why he expects markets to take a breather. Isaac Boltanski of BTIG on why House Speaker Mike Johnson could be at risk of losing his job. And Deputy Treasury Secretary Wally Adeyemo discussing a fresh round of sanctions on Russia. We begin with our top story. Stocks hitting record highs lifted by Nvidia's blowout earnings report. But Morgan Stanley's Andrew Sliman expecting a cool down, saying this: 2023 was an extremely low volatility year. Historically, the next year is much more volatile and challenges the bullish thesis much more often. That doesn't mean 2024 won't be a decent year for equities, just a lot more gut checks. However, I don't expect more of a correction until later in the year. Earnings are coming in too strong. Andrew joins us right now. Let's talk about those strong earnings, Andrew. Nvidia, blowout report. Is it everybody or is it just one name that's driving that earnings story?
Well, I think that story is, kind of sucking the air out of the room, because the fact is 78% of companies have beaten. You look at the consensus earnings for this year and next year, they've gone up, not even including Nvidia yesterday. So I think there's a lot of opportunity in the market that's beyond just, Nvidia and the whole AI story.
Andrew, can we talk about the market cap change, though, just on that name? It's phenomenal, just the size of it. 3 weeks ago, we were talking about Meta adding 200 billion. 3 weeks later, Nvidia adds something like 276.65 billion in a single day. Andrew, I was going through the list of companies that have got a market cap smaller than what we added to Nvidia yesterday. Salesforce, Netflix, Bank of America, Coca-Cola. We added a McDonald's yesterday. We added a Disney, a Netflix. Andrew, can you make sense of that? How is that possible?
I think it's possible because if you look at earnings growth for the company in the last 2 years, it's actually higher than their stock return, which means the PE's actually come down since the end of 2022. That's pretty incredible to me. So it's a story about earnings growth and earnings revisions. That's what that's what drives stocks. And I understand there's another issue, which is interest rates and what's the right valuation. But right now, we've just come off a very strong earnings season for a lot of companies, and the market is focused on that, and that's why we've started the year very strong.
Yeah, Andrew, Jay Pulaski here, and I think your points are well taken. What's interesting to me when you talk about revisions is that if you look into the third quarter and fourth quarter, the non-Magnificent Seven, so the other 493 as we're calling them, have actually expected to have higher earnings growth than the Magnificent Seven, and kind of supports the view that we have at TPW, which is we're in the early stages of a cyclical recovery. So we're not only involved with tech, but also transports, home builders, industrials, et cetera. And I just wonder if you share that point of view.
Well, yeah, I mean, look, one of the mistakes I think people make is they talk about what's the return if I enter the market now. What's my return for the year, i.e. on December 31st when the dust settles? And I think what you have to remember that is on December 31st, the market is going to be priced off of next 12 months earnings, which is not 2024 earnings. It's going to be 2025 earnings. And 2025 earnings right now is 275. It's actually gone up the last couple days because of strong earnings. So does that support a market above 5,000? Yeah, you betcha. So I'm always fixated on what's the out year earnings revision, because that's going to determine where the market ends this year.
Yeah,
and you're seeing it across the board in a lot of industries. It's not just tech. I mean, one of the areas we like a lot is the industrials because of the infrastructure play. But we hear from the retailers that the consumer is actually making bigger ticket purchases lately. So I think there's a lot of areas beyond just this AI story.
Yeah, no, I think that's absolutely right, Andrew. And I noted yesterday that there were more new highs in the industrial sector than there were in the tech sector. Same with financials. So that's one of the things I think people are missing because there's so much focus on the Magnificent Seven, is that this is a broad market move. And if you look at equal-weighted S&P, if you look at equal-weighted NASDAQ, those are also breaking out. And you have numerous sectors other than technology breaking out. And that earnings point that you make about looking out into 2025, I share that exactly. We're looking for 2 to 3 years of solid earnings growth, what we call kind of a blue sky outlook as we go into a global economic recovery.
Andrew, you're looking for the same thing?
Yeah, I mean, but having said that, as you began the segment, Jonathan, pointing out, the VIX, it was too easy. I mean, a lot of people were bearish last year, but if you were bullish, it was pretty easy to make money in stocks. The market pretty much went straight up. We barely had a pullback in early fall. I've been around this business a long time to know it's never easy 2 years in a row. So somewhere along the way, we're going to get a bump. And what's kind of tragic, Jonathan, is that the first year off a bear market low, retail sells. They get out. It happened in 2020, it happened in 2009, and it happened in 2023. There was net selling. And what happens in the second year, and this is why the market's surging right now, is retail flips and says, oh my God, I made a mistake. I shouldn't have been selling. And they start to come back in the market. And what happens is they capture that more volatile year. So I think the analogy, as much as the political, economic situation is very different than after the great financial crisis. In 2009, the market took off. Retail were sellers. 2010, the market was up 12%, but we had a 16% pullback in the summer of 2010. I suspect it'll be similar this time again, which is a good year, but more gut-wrenching, more volatility, because the VIX is just, no one talks about it anymore. It's as if it doesn't exist.
Andrew, one thing I've learned, it's never easy. It's only easy looking back. I remember last spring when banks were failing, it didn't feel easy then. Let's be clear about that. Andrew, you should give yourself some more credit for being bullish last year, because you were through much of that year. Clearly, you think we should lighten up a little bit here, Andrew. When you think about lightening up, where would you do it?
Well, I think some of these names have really had big moves, certainly, the AI stories. But one of the things that I see that's beneficial this year is that the Mag 7 the returns are dispersing. So not all of them are doing well. So that creates some opportunity to choose the ones that are, hey, they're doing well, they've had good revisions, versus some that are not. So I would focus on the companies that have reported good numbers. I've learned in this business, there's rarely one good quarter and there's rarely one bad quarter. And so I stick with companies that are surprising on the upside and forcing Wall Street to revise higher. And again, maybe the tech area is overbought right now, but I saw a lot of financial stocks that reported pretty good numbers. I think the capital markets are reopening. That's going to be good for the big banks. As money moves out of money markets and into higher fee-paying products, bond funds, equities, alternatives, that's going to be good for the asset/wealth management business. So I think there are opportunities to focus on as the market has seemingly fixated just on semiconductors and AI of late.
Andrew Sliman at Morgan Stanley. Andrew, great to hear you, sir. To go through some of your thoughts. Jay, you were nodding along to that. Just the cash and money market funds. Do we need rate cuts to unleash that, or just more gains in this stock market to attract it?
No, I think it's probably a little bit of both, John, right? I mean, when we put out our 2024 outlook, we talked about 4 macro surprises. One of them was the return to stability, and we think we're getting that. And we paired that with this idea of $1 trillion reward. And that $1 trillion was basically the trillion that went into money market funds last year is going to start to come out. Because when when things look dire or ugly, as they did both in the spring and the fall last year, 5% on cash seems like, wow, I like that. But when the market's up 15 or 20% and there are names that are going up 20% or more, then that's not as appealing. So we think as we go through this period and it becomes increasingly clear that we're in a multi-year economic recovery that can stretch, then cash is going to come out of that money market fund. And that's why I think that pullbacks will happen, but they're not going to be as deep because they're going to be buyers coming in.
Just to set up the next hour with you, I think 2 perceived disconnects that we need to work through with you. One is the disconnect seemingly between equity markets abroad hitting all-time highs and yet GDP is negative, and we can touch on that a little bit later. The other disconnect is the one you've already addressed, and I think it's worth going over again. The fact that we could price out these interest rate cuts, push out the timing and reduce the magnitude, and equity markets have carried on rallying, even though a lot of people justified the rally from the back end of October into the new year off the back of a Fed pivot and more rate cuts coming in 2024. Can you just walk us through again why you think that's happened?
Yeah, no, we wrote our piece. You know, we write every Friday, and we'll be writing when we get off the set here today. And our title last week was Handoff. And this was the whole point. We went through exactly this, that we have handed off the underlying vitality of the market from expecting rate cuts, dependency on the Fed, which we don't want to be dependent, right? We want to be free, versus earnings growth, where we're free to see that earnings growth. And we do see 2024 and 2025, double-digit earnings growth in the S&P. And the rest of the world has good earnings growth, too. And so the market has been able to make that switch and do it confidently. And you see the rewards with NVIDIA. NVIDIA's earnings were up 760% year on year. 760% year on year, John, right? It's crazy. But what it does is it reveals 2 things. One, Wall Street's failure of imagination, which was the title of another piece of mine a couple weeks ago. And 2, the fact that this earnings story is real. It's real. And if you don't buy it, you are going to be left behind. Think of the people who are active managers, and we've talked about this before.
I called it career risk yesterday.
Yeah, exactly. Think of the people who are running money professionally and are not fully exposed to technology. You are, by definition, underperforming, and it's not even the end of February, right? You're coming out of the gate. You underperformed last year. Worst year for active managers, I think, almost ever, relative to benchmark. Okay, you've underperformed last year. Now you're underperforming this year. I just don't see any big pullbacks because I think there are people who are going to need to participate. And again, it's not just tech. Transport's breaking out, home builders breaking out, industrial's breaking out. There are pieces that haven't participated, and we expect that they will, and that's where we're paying attention.
You've been bullish, and you're right to be so far. You're going to stick with us. We've got some issues to work through. Equity futures right now on the S&P, no issue here, no drama. We're positive by 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. Shares of Carvana surging this morning. The online used car dealer beat fourth quarter expectations for profit and said it expects better earnings this quarter. Carvana's performance come after a year of cuts and debt reduction. And in a statement, the company admits the macroeconomic environment is still uncertain, but it still expects to increase sales over a year-over-year basis. And Reddit, long-awaited listing, filed for an initial public offering, revealing the social media platform's shrinking losses. The San Francisco-based company filed with the SEC more than 2 years after first submitting its plan confidentially, and it's expected to be one of the biggest IPOs of the year. It would trade under the ticker RDDT. And the new sports streaming merger between Disney, Fox, and Warner Brothers could attract 38 million subscribers by 2032. That's according to estimates by Citigroup. That would represent about half of the U.S. households that like sports, with the bulk of those subscribers coming from cable TV customers cutting the cord for a cheaper alternative. The service is expected to cost between $35 and $40 per month. That's your Bloomberg Brief, John.
Hey, Shonali, thank you. Up next on this program, another government shutdown deadline looming.
The question is more about, are we going to get another short-term continuing resolution? I think the two possibilities are either we get a CR, or I would not be that surprised to see a short-term shutdown.
That conversation up next, live from New York. This is Bloomberg. One hour, 12 minutes away from the opening bell in New York City on Wall Street. Equity futures on the S&P positive by 0.1%. On the S&P, yields lower by a single basis point on a 10-year yield, 430.70. Under surveillance this morning, another government shutdown deadline looming.
The question is more about, are we going to get another short-term continuing resolution? I think the two possibilities are either we get a CR, or I would not be that surprised to see a short-term shutdown. But Speaker Johnson, I think, has shown he really does not want a shutdown. He promised he was never going to do another short-term CR in advance of the last shutdown deadline. And of course, he ended up doing so. So, push is coming to shove right now.
It's the latest this morning. Congress set to return from recess next Wednesday, leaving just 2 days to avoid a partial government shutdown on Friday, March 1. Isaac Boltanski of BTIG laying out 3 options he sees for House Speaker Mike Johnson: punting the deadlines once more, passing another stopgap, or compromising with Democrats and risking his job. Isaac joins us now for more. Base case, Isaac, your call out of those 3, punt or compromise?
Good morning. I think that we're going to have a short-term shutdown, and I think that we need to have that pain here in D.C. for folks to be able to move on and do the inevitable, which is most likely pushing a CR through the end of this fiscal year. I think that that's what we're going to see. But first and foremost, I do think that we are going to see a shutdown. I think that that's where the politics are. I think that we need that pain in town to force folks from their rigid negotiating positions. And I would also just say, I think, I've been taken aback here. Speaker Johnson has a really tough job. It is an impossible job, some might say, to govern the ungovernable. But I will say he's been very underwhelming thus far in this role in terms of marshaling his caucus and actually setting expectations that are realistic. And so, look, my base case is we have a shutdown.
How short of a shutdown, though? Is it just from March 1st to 8th to get to the second tranche, or is it longer in duration?
And this is the one thing that I keep pounding home to clients. I don't know how long it's going to be, but I think it's going to be only a few days. And I'm begging everyone, don't pay attention to it. You should not care as an investor. Any missed economic activity will be made up on the other side. This is nothing but political theater. We've seen it 1,000 times. And it doesn't impact the things that really matter for investors, like the debt ceiling.
When you look at political theater upcoming tomorrow, the South Carolina primary, Trump is leading Nikki Haley north of 28 points. What does she do after this?
Look, she's given every signal that she's going to stay in the race. And I think she's staying in the race in case we see a massive stumble from the former president. And I think that is the lane that she's going to maintain. But I can tell you the number one question I get from clients, and it's usually in an exasperated, tired tone, is, goodness gracious, will this really be Biden v. Trump again? The answer is yes. The answer is yes. I think that Trump is going to win in South Carolina. I think he's going to march to the nomination through Super Tuesday in a couple weeks. And we need to start embracing the reality that this is going to be Biden v. Trump again.
Hey, Isaac, Jay Pawlowski here, and that's a great setup for my question, which is, I'm in print saying that I expect Trump to lose by a landslide. Am I crazy?
Yeah, look, my cautionary point in all of this is, if you go back to the last election, that election was decided by 40,000 voters in 3 states. And so I think we can go in with our base cases for all of this, but I think, we'll take some lessons from the Fed chairman and have some humility around this in terms of who knows what we're going to be talking about in a few months. 5 months ago, there wasn't war in the Middle East, and Speaker McCarthy had the gavel in the House. So who knows what we'll be talking about? And that's my cautionary point in all of this.
Jay, what underpins this call?
Well, I think there are a couple of things. Trump has to be so extreme to maintain his base that he's turning off virtually everybody else. Then on the Democratic side, you have abortion. You have a lot of energy to come to the table and vote. You see the money Biden has more money than any Democratic nominee has ever had. You see Trump failing to really raise money and spend most of the money he's raising to pay off his legal bills. He's got all the challenges ahead. And I think there's just going to be an outpouring that suggests that, notwithstanding battleground states and limited numbers of people, I think the overwhelming kind of turnout of the Democrats is going to lead to that outcome.
The money is a real problem, and Trump is facing a cash crunch come this summer. But the issue, when you look at what people care about, it's the economy and immigration. And Trump continues to lead Biden on those top 2 issues, Jonathan. So I'm not sure that at this point, similar to Isaac's point, what happens with the border? Where are we come this summer with the economy and inflation numbers to really decide who wins? Because these are the issues the American consumer cares about.
Jay, you see it in the polling repeatedly, immigration, the economy. The president doesn't do too well. Why do you think that's somewhat misleading to the ultimate overall outcome in November?
Yeah, no, Annmarie hits it on the head, and that's one of the things that you want to mention is the economy. And I think, look, the economy is clearly turning, and consumer confidence is turning, and kind of how people vote ties in nicely with that consumer confidence data, and that is clearly turning up and trending up. And so therefore, exactly to the point, we're going to have the election in 6-9 months. And by that time, I think it's going to be clear that the economy is doing much better. Immigration, I think it's pretty clear that if you're paying attention, the Republicans are not allowing it to be solved. Yeah. And therefore, the president can run on that all day.
Isaac, I want to give you the final word, please.
I think that past elections have been determined in large part by economic realities on the ground. We can always say it's the economy, stupid. We've learned that time and time again. This election, I think, is going to be different. This election is going to be driven by anger and fear and different drivers than just how is your wallet doing. And so I think that we've got to think about more broadly than just consumer confidence, which is absolutely one of the inputs. But we've got to be aware of crime and the border. And this election, each side will be pushing anger and fear in different ways. And I think that is a different motivator than we've seen in previous election cycles.
Isaac, great to catch up with you, sir. Appreciate it. We've got to do this again soon. Isaac Boltanski there of BTIG. What did you make of that final point? That this is a lot more nuanced than maybe we give it credit for?
Well, I think that's, I guess we're sitting here in the media, but, there's a lot
of... It's easier to forecast the weather and markets, to be fair.
It is,
when you look at surveys, they're so political. You ask a Republican how they're feeling about the economy, and they say it's terrible, gloomy. You ask a Democrat, and they say it's fantastic. It's the best economy we've seen in years.
You ask them how they feel about their state. If they're in a red state, you ask a Republican, they feel pretty good about the state they're in right now.
Yeah.
But does that mean they're going to still vote for Joe Biden? No.
They're not going to give Biden the credit for that at all.
At all. No.
Jay,
but I think the issue is that Trump has a very a small base that really believes in him deeply. I think beyond that, people are open to discussion and negotiation, and that's what it's going to lead to.
We've got a lot more to talk about. Coming up next on this programme, Citi global economist Robert Sokin on why he still expects a recession later this year and why Jay is really constructive on global growth and global equity markets. That conversation up next. 60 minutes out from the opening bell, equity futures on the S&P 500 doing okay, just about unchanged going into that cash open, positive by 0.1%. Likewise on the Nasdaq, coming into Friday, all-time highs and seeking out another solid week of gains on both the Nasdaq and on the S&P 500. If you switch up the board and get to the bond market, 2-year, 10-year, 30-year, that 2-year has repriced big time since the end of January from 420 out to 470, 471.11 on a 2-year. Totally unchanged on the session, but up a lot over the last 3 weeks or so. Andrew Holdenhorst of Citi just publishing, echoing Governor Waller, what's the rush? We have consistently expected that elevated inflation, solid activity data early this year would keep the Fed from cutting rates before June, raising the probability that the economy is entering recession once cuts are delivered. The view from Citi in just a moment. If you turn to foreign exchange, the euro shaping up as follows. It's doing all right. The euro stronger against the dollar, 108.31 on that currency pair, positive by almost 0.1%. Under surveillance this morning, the magnificent one's stellar week continues. Nvidia shares surging to an all-time high yesterday, the biggest single session gain in market value ever. Shares jumping 16%, adding about $277 billion in market cap and bringing the chip maker's total market value near $2 trillion. Nvidia's surge surpassing the $197 billion single-day gain made by Meta only 3 weeks ago. Jay, do we have to stop talking about these numbers so that we don't get distracted by the underlying profits that this company is actually generating? Because when you hear things like, we just added a Netflix, we just added a Pepsi, we just added a Salesforce, it's very difficult to process why we should be able to do that in a single day.
100%, John. And I think it actually, though, it reflects a little bit of Wall Street's failure of imagination. The fact that you've got a 16% move in a single day reflects that no one has wrapped their head around what this could actually look like and what this market looks like. And AI is global and AI is moving at speed. And we are struggling to deal with the speed of change as investors. And our models don't really incorporate this. And going forward, it's only going to continue to accelerate.
Can we talk about the failure of imagination? It always reminds me of this interview from a long time ago, more than 20 years ago. And I think it was an Amazon analyst being interviewed by quite a smug journalist without any imagination, who wanted to understand from this journalist, and I did learn the lesson from this, don't worry. I wanted to understand from the analyst how Amazon could be worth more than Sears. And really sat there with conviction saying, this is ridiculous. How on earth would be Amazon worth be more than Sears, et cetera, et cetera? How can a bookseller, because that's the way people saw Amazon at the time, how can a bookseller become this? Are we repeating that now?
Yeah, I think we're at a place of change, of rapid change and innovation. And we're at the beginning. And so for us, for me as an investor, right, I'm trying to pay attention to the people who are the best minds in that space. And the guys who are and the women who are at the front of the train. And NVIDIA's CEO, Jensen, is at the front of the train. And when he lays out what he's seeing, and then it's corroborated by others who are in the similar space, and look, this is global. Every country, and this is a big theme of ours, right, at TPW, climate, conflict, COVID, these are global themes. Every government has to have an AI strategy. Every AI strategy has to incorporate NVIDIA chips. The TAM, right, total addressable market, is global. Everyone's got to play, and they have a monopoly. And so for us, we talked a couple weeks ago, John, about the Magnificent Six in Europe, right? Because there are European companies. You look at Asia, you have South Korea and Japan tying up to develop semiconductor production outside of China. Everyone wants a fab plant, right? Everyone wants an electric vehicle battery plant. This is bullish for global growth. This is bullish for company earnings. This is bullish for the next couple of years.
We'll get into that in just a moment. Let's talk about government policy as well. The Biden administration cracking down on Russia with a new set of sanctions. The package is expected to target 500 people and entities linked to the country's war effort. President Biden teasing the new penalty shortly after the sudden death of Russian opposition leader Alexei Navalny last week. This weekend also marking 2 years since Russia's invasion of Ukraine. We'll be catching up with the Deputy Treasury Secretary, Wally Adeyemo, in just about 10 minutes' time, Annmarie, to go through some of these issues. What is the number one issue outstanding now for you?
Well, when you look at what they're about to announce, you need to know the names and the entities, but I largely view this as symbolic. So today what you're going to hear a lot from the administration is they're going to punt to the fact that they need to get more aid to Ukraine and try to use this to put some pressure on Republicans. But the issue for me, Jonathan, is sanctions haven't fully worked. At least not what the president said that he wanted to do, which was crush the ruble and half their economy. What did Mohamed El-Erian tell us? The IMF upgrading their growth. they have just found new markets when you look at what they are exporting and also how they're bringing things in. You know, they're stripping things like refrigerators to find the technology they need to then work on their war machine.
Jay, we talked to Mohammed about this last hour, about the elephant in the room. And the elephant in the room right now is the frozen assets, $300 billion worth, and what we do with them. If Western governments confiscate those assets, and by Western governments we're talking primarily about Belgium and France, they go forward with that. Do you see emerging market economies, emerging market governments dumping Western currencies because we've set a pretty tricky precedent?
Well, I think, again, it's people who are in that position. It's kind of like who have committed crimes worry about immunity. It's the same type of thing, right? If you've done something like invaded another country, then you may look to have your assets confiscated. Very few people do that. I mean, I think the issue here for us is the fact that defense spending is actually leading to deeper European integration. And so you look at NATO enlargement, you look at what's happening in Europe. This is bringing Europe together, not just because of the conflict with Russia, but also because they haven't been able to depend on the United States to the amount that they would have expected, you know, previously. And so that's, in our view, bullish for European integration.
Interesting. I want to finish on this on the Federal Reserve and just turn to the latest call from Goldman Sachs. Economists once again pushing back their rate cut bet to June. A team led by Jan Hatzius dropping its forecast for a cut in May, now anticipating 4 reductions this year: June, July, September, December. Goldman's shift coming after this week's Fed minutes and comments from 3 top Fed officials, Jefferson, Cook and Waller, all saying the central bank is on track to cut this year, just not anytime soon. Robert Sockin and the team over at Citi expecting the first Fed cut in June and 125 basis points of easing for the year, writing this: a recession, which we still expect to occur around mid-year, gives the Fed a reason to cut. Without a recession, the Fed is likely to deliver only a few cuts this year. Rob joins us around the table to talk about this a little bit more. Rob, good to see you again.
Good to see you.
So recession, later rate cuts. Why the recession? Ultimately, let's start there. We've had decent data to start the year. Why do you still have that recession call?
Yeah, and this is the key question. And I think, especially if you look last year, you were seeing particularly soft landing type of data, very resilient growth, moderating inflation. But we would still seeing some cracks within the system that argue a recession may occur. Credit conditions continue to tighten. Stresses in lower income consumers persist. The fiscal impulse that was there last year is not going to be there this year. And you add all these things up, there's a lot of risk. But basically, it comes down to, we think, as the longer that these policy rates stay elevated, the more that they're going to bite into the economy. And also that services momentum from the consumer that really powered growth last year is not going to be there as much this year. So as those things fade and those interest rates bite, we think the economy, those stresses are going to grow, and the economy will eventually, fall into recession.
You've got a very, very different view to Jay. So Jay's itching to jump in. Can I just set up the economy call as well for the global economy? If you strip out the United States, what is the engine for growth right now?
Yeah, and that's the key question. And if you look at our global forecasts, we have kind of emerging markets holding up relatively well. Those economies that did really well last year, like Brazil and Mexico, they slowed down a bit, but still are pretty solid within the forecast. So I would say the EMs are still, broadly speaking, a decent engine for growth. It's on the DM side that the U.S. is really carrying the ship. I mean, if you look within Europe, I don't see a lot of upside risk there. You're talking about slightly negative, 0 or slightly positive growth for the year. That's kind of the balance of the distribution. It's the U.S. where there's still that risk of a soft landing and could be an engine for the global economy, just like it was last year.
Yeah, I mean, I think, Rob, it's an interesting point of view. We take a different side of it, right? When we wrote our 2024 outlook, we talked about an early cycle recovery. And when we look at things like the semi-cycle, the home builders, ISM new orders breaking back above 50, we see a number of things that suggest we're early cycle. And then when we look kind of more broadly and extend it for a year or two, we're looking at a rate cutting cycle globally, global liquidity, global earnings, all pretty positive. China growing at 5%, Europe full employment. The production side is weak in Europe, but certainly the consumption side is okay. And when you look at Japan, same type of thing. Japan just hit a new all-time high, right?
Yeah.
35 years. I mean, how often do you get a 35-year new all-time high? So we have a more constructive view, and I just wonder if that upcycle kind of papers over some of the cracks that you point out, which I agree do exist.
Yeah, and that's a really great point. And as I mentioned, those stresses that I highlighted, the lower income consumer strains, the credit conditions tightening. There's certainly yellow warning signs at this stage and not red. And you could get an environment where, central banks are clearly set to ease this year, and that could help offset some of those stresses. The question is, are they able to do that in a way that offset it soon enough? Mm-hmm. And I agree, there are some green shoots, as you highlighted. The manufacturing PMI, for example, just touched near 50 for the first time since the third quarter of 2022. So it's a really difficult time to assess the confluence of data. I think the risk of a softer landing is pretty high, but I think those factors that I mentioned, that services momentum fading, those interest rates, which are rising on a real basis because inflation's fallen so much, I think are going to bite more. And fiscal, I think, is a story underneath the surface that doesn't get a lot of attention. If you look globally, almost all economies around the world are having a negative fiscal impulse this year. Whereas take for the U.S. last year, that was one of the big upside surprises.
This right here, Rob, and I'm pleased you brought it up, is the second perceived disconnect. We talked about rates and the equity markets continue to rally. I want to finish on GDP worldwide. The UK's negative, Germany's negative, Japan's negative. We talked about this repeatedly all week. China is clearly struggling, and yet we've seen markets in certain countries, Japan, Germany, France, Europe, at all-time highs. So you've sort of explained how rates can reprice higher and equity markets in the States can carry on running. How have we managed to do this abroad?
Yeah, no, I think it's the same thing, John, right? The lesson that we always have to remember, markets are forward-looking, right? And forward-looking, Europe is going to recover. Japan is going to recover. China is growing at 4 to 5%. If you look at exports, another thing I didn't mention, but if you look at exports coming out of Japan, coming out of South Korea, coming out of Taiwan, they're picking up and picking up meaningfully. And so to me, it's a case of the market knows best, and the market is telling us with these new highs that earnings are going to be fine, because it's really earnings. It's not GDP. It's earnings. We know that too. If you thought GDP was what you focused on, just look at China, fastest growing economy in the world for a decade, one of the worst stock markets. Okay,
yeah, that's true.
So earnings are what count, and the market is saying to us, and we need to pay attention. The global economy is in the beginning of a multi-year upcycle led by those factors I mentioned: rate cuts, liquidity, the reshoring of supply chains. We think the analog is the second half of the 90s. That's what we're looking at. A global productivity boom where AI really supports low inflation, decent wage growth, continued consumption, and an economy that's going to grow for the next 2 to 3 years.
And to your point, I think, as you said, markets are forward-looking. And one thing we have been highlighting, even though our outlook for the global economy is more bearish than most, is the saving grace is kind of these recessions are all relatively short-lived, relatively mild. I mean, even if you look at the end of last year, for Japan, the UK, relatively small contractions. And after that, central banks are able to start cutting rates, inflation moderates, and growth bounces back pretty quickly. So if you're forward-looking, as you said, these are relatively short blips in terms of downturns.
That's the hope if you're bullish European equity markets right now, that's for sure. Rob, it's good to see you.
Pleasure.
As always, thank you, sir.
So
Robert Sockin there of Citi. Jay Pilowski of TPW is going to stick with us. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Shonali Basak. Hey, Shonali.
Hey, John. Warner Brothers Discovery missed on revenue for the fourth quarter in earnings posted this morning. The media company says last year's writers and actors strikes weighed on TV, posting a 20% decline in content revenue. However, Warner Brothers Discovery did see a beat on total subscribers with nearly 98 million customers. And CEO David Zaslav added that the streaming service Max will be rolled out to new international markets. The huge rally in NVIDIA shares has catapulted CEO Jensen Huang to new heights. He's on the verge of becoming one of the 20th richest people in the world. Huang's wealth jumped $9.6 billion yesterday to more than $69 billion. And it's a gain that leapfrogged him ahead of Charles Koch to the 21st place on the Bloomberg Billionaires Index. And House Speaker Mike Johnson is rejecting new border policy restrictions considered by the Biden administration, calling them election year gimmicks. President Biden is weighing an executive order to block asylum claims by migrants who cross the border outside of official ports of entry. The speaker has sought one-on-one talks with Biden on border policy in exchange for international aid. Speaker Johnson has refused to allow members a vote on the standalone aid package, which passed the Senate earlier this month. And that's your Bloomberg Brief, John.
Shonali, thank you. Up next on this program, the Biden administration cracking down on Russia.
In terms of new measures and additional sanctions, stay tuned. They will be forthcoming.
The Deputy Secretary of the Treasury, Wally Adeyemo, joins this programme up next. Live from New York City this morning. Good morning to you all. We're counting you down to the opening bell. That is about 43 minutes away. Equity futures positive by 0.1%. Under surveillance this morning, the Biden administration cracking down on Russia.
It's actually quite a useful reminder to Russia about what virtually the entire world thinks of this aggression and the strong desire to see it end. In terms of new measures and additional sanctions, stay tuned. They will be forthcoming.
Well, here they are. Here's the latest. President Biden slapping Russia with a set of 500 fresh sanctions after the death of opposition leader Alexei Navalny. The White House saying some of the sanctions will target those responsible for Navalny's death, with the majority aimed at Putin's so-called war machine. The sanctions landing as the Russia-Ukraine war hits the 2-year mark. Joining us now to discuss is Deputy Treasury Secretary Wally Adeyemo. Wally, great to see you in person, sir. Fantastic to have you with us around a table. Let's start with the recent effort. There isn't much that you haven't sanctioned over the last 2 years. What's new about this, and what's the objective?
Important to remember that our objective remains the same, going after Russia's military-industrialized complex and their ability to earn money to prop up their economy and buy the goods they need to fight the war they want. What we're doing today is we are furthering those actions by going after companies in Russia that are helping to build military equipment. Today, Russia is running a wartime economy. Factories that used to produce goods for Russian civilians now are producing military equipment. We're sanctioning those companies, but we're also going after the companies that supply them in third countries in order to make clear to companies in third countries that you have a choice. You can do business with Russia and their military-industrialized complex, or you can do business with the United States and our allies and partners who are joining us in this effort.
What's India's answer to that right now?
What we've seen from companies in India, but companies around the world, is that when they have a choice between being able to sell things to 50% of the global economy versus selling things to Russia's military-industrialized complex, the choice is pretty easy for them. The key thing that we're doing today is we're sanctioning a number of companies you've never heard of that Russia has set up to try and buy things from India and other countries. And by sanctioning those companies, we put them on the radar of companies in India and in countries around the world, and they know that they can no longer do business with them.
When you look at the Russian economy, though, the IMF has upgraded their growth forecast for it. Sanctions haven't worked in the sense that the ruble has not been brought to rubble, as President Biden promised. Have sanctions worked, or they've just created new markets?
So it's important for us to remember what our objectives are with sanctions. They're to do two things: reduce Russia's revenues and put sand in the gears of the military-industrialized complex. Russia's revenues from selling oil, their most important product, down 40% because of the price cap and the sanctions that we've put in place, and we've promised to do more. Russia's expenses for their military are up 70%. Your viewers, they run companies, they invest. Any company where the expenses are up 70% and revenues are down 40% is not an investable economy. Russia's GDP is up, you're right, because they're spending more, but so is inflation and so are interest rates, and over time, that leads to a formula of a country getting smaller and weaker, not stronger.
The price cap, though, it hasn't worked all the time. Russia is using shadow fleets. Very hard to track this. So there are times when they are just selling carte blanche how much they want to India and China. India has basically replaced Europe. So they have found a way to go around U.S. sanctions to continue funding their war, because Putin funds his war by oil and gas exports.
So you're right that Russia is looking for ways to circumvent our sanctions, but the route you mentioned there is one where what the Russians have are two choices. One is sell oil under the price cap for under $60, or to build up their own shadow fleet. But in order to build that shadow fleet, they have to invest in tankers, not tanks. Every dollar they spend buying a new tanker, every dollar they spend building up their own ecosystem is a dollar they can't spend on this war of choice in Ukraine, and we're going to continue to force them to make those kind of hard choices.
Need to talk about the elephant in the room, $300 billion of Russian reserves. The bulk of that is in Belgium and in France. How close are we to a decision on confiscating those reserves?
So it's important to remember that just in December, our leaders set out to have experts talk about what we can do to make sure that Russia doesn't choose when it's going to pay Ukraine for the damages it's done. Over the course of the last several weeks, we've sat down with experts across the G7, and we're looking for ways to unlock the economic value of those reserves for the Ukrainian people. We're already seeing Europe take a step, for example, the windfall profits tax, which they're using to take the profits from some of the companies there to move to Ukraine. And over time, we're going to continue working to look for new ways to unlock that economic value.
Can you help me understand how that happens when Belgium and France, who aren't in direct conflict with Russia, how do they go about doing that?
So the thing that we know is that ultimately what Russia has done is violated international law. Our leaders have made very clear that Russia is not getting back these assets until they pay for reconstruction in Ukraine. Ultimately, Russia needs to end this war, and our goal is to make sure that we can use the assets that Russia has around the world to fundamentally find ways to help.
You're concerned, though, Wally, about undermining the rules-based order that we all sit around this table and claim to support, that ultimately, if this sets a precedent, that maybe other economies, Western emerging market economies, will look at what's happening in the West and say, I don't want any exposure to that currency anymore at all. Are you worried about that?
I think it's important for us to remember that ultimately one of the strengths of the coalition we've built is that it represents the world's largest reserve currencies. And what we're committed to doing, if we take an action, is taking it across the G7. Fundamentally, we do think that Russia has a legal obligation to compensate Ukraine for the damage that they've done. We have to remember that Russia is the one who violated that rules-based order by invading Ukraine. And ultimately, every action we will take will be in keeping with international law, will be in keeping with making sure that Ukraine is able to be a functioning democracy. Our goal here is to use sanctions and use our economic tools to slow down Russia. But ultimately, in order to speed up Ukraine, they need money. That's why the president's focus on getting Congress to act. That's why we're thinking about ways that we can use Russian assets, the economic value of Russian assets to support the Ukrainian people. Because ultimately what we have to do is ensure that Russia learns the important lesson that you can't violate the rules-based order and get away with it.
Deputy Secretary, there's one space in the Russian economy that actually, though, has been a little bit safe, and that's the metals market. Why are you not going after nickel and aluminum?
I would wait for a few minutes when we announce our sanctions, and you'll see that we're going after a number of revenue sources. And what I want to make clear to Russia is that as long as their invasion continues, we're going to continue to go after their revenue sources and also after the military-industrialized complex.
Well, you can't tease that without telling us. So you're going after nickel and aluminum.
I'm not going to preview the exact sanctions that we're doing, but
what
I will say
for,
that
then,
what I will say.
The market thinks you're going after nickel and aluminum. Is the market right?
What I will say is that we are going after the sectors of the economy that help Russia earn revenue. That includes commodities. We know that that includes oil, and we've went after the price cap. And what we've done is we've done it in a targeted way that has accomplished two goals. One is making it harder for Russia to earn revenue, while also taking steps to make sure that we protect the rest of the global economy from the repercussions of our actions. And we succeeded at doing that. And you mentioned the price cap, where Russia today is earning less revenue. You don't have to believe me. The Russian Deputy Prime Minister just a few weeks ago complained about the impact the Russian price cap is having on them. Ultimately, our goal is to make that impact greater over time by taking these actions, while also stabilizing markets and making sure that global prices don't rise.
In the same breath, Alexander Novak is also talking about the fact that they're able to get an entrance into India. India has basically replaced Europe for them. They're still making a ton of money. And I guess my point is, until the U.S. is willing to take on the repercussions of what it would mean for their economies, should we just expect this war to continue?
No, you've got to look at what the Ukrainians have been able to do. Ultimately, 2 years ago, when we were sitting here, Russia thought they would take the Ukrainian capital in days and take the whole country in weeks. Ukraine has demonstrated to us that they have the ability to defeat the Russians, but they need two things. One is what we're doing with sanctions and export controls to slow down the Russians, but they also need money in order to make sure that they have the weapons they need to defend themselves. And that's why it's so critical that Congress act to give them the weapons they need to move forward, because we've seen throughout history, we know how to defeat tyrants, but that requires us to take actions that we're doing with sanctions, but also the actions in terms of providing them with financial resources.
Sir, it's good to see you here in New York. I'd love to catch up at some point in the near future and talk about Nippon Steel as well, and the steel industry in America. We've got a lot to discuss.
Well, I look forward to being back. Thank you guys for having me.
Thank you, sir. Wally Adeyemo there, the US Deputy Treasury Secretary. A special thanks to Jay Pilosky at TPW. Very bullish on this global economy and this global equity market. Jay, thank you. To all of you at home, have a wonderful weekend. We'll catch up with you on Monday. Lindsay Piegser of Stifel, Michael Schall of Marketfield, Sebastian Rishapra of SocGen, Jim Bianco of Bianco Research. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.